Good morning, good morning. It's Monday, the 13th of January, and what a non-farm Chris Beecham.
What a day. What a day it was on Friday.
Did that ruin your weekend?
No, not at all.
Excellent.
Really. It's really interesting, I think, to see that number come through. And yeah, it started off the year on a bad foot, because if you look at what they call the January barometer, which is the first...
Hang on, Chris, hang on. We got to do the British thing.
Oh, sorry, we have to
chatting
polite
about
first. Yes, how was your weekend?
That's it. That's what I was looking for.
Did you have a nice weekend?
I had a wonderful weekend. Thank you, everybody, for asking. It was, of course, my birthday on Saturday.
Was it? Oh, happy birthday.
Indeed. Thank you.
21?
Well, that's actually genuinely the first time you've heard that it's my birthday, wasn't it?
It is, yeah. It is very true, because you kept that one very quiet. You wouldn't talk to me.
I got messages from Fred. I got messages from all the gallery.
I'm going to message you now on Teams.
Not a single message. Thanks, guys. By the way, it was my birthday on Saturday, just in case any of you didn't realise. Good morning.
Funds can be sent to the usual place, I assume.
What's that?
Money can be sent to the usual place.
Yes. Yeah. Direct debits.
Yeah. Bank drafts, that kind of thing.
Good morning, Gavin Ackers. Thank you very much for your feedback on fast markets this morning. That's been great to hear. Very happy to hear that you're enjoying that segment. Monkey Man. Now, Monkey Man, we've got a story for you coming up in the Times. Now we've found out what you do for a living. Very happy to hear that. Dave G, good morning. Julian, we got a full... God, we're really back to work now, aren't we? Everybody's on the chat this morning. Carl Wolf, Riyadh, good morning to you. Welcome. And yes, so for my birthday...
Did you get anything nice?
Yes, no, because my mum's watching the show. So I got a lovely training top from my mother.
Right.
She thinks I'm a medium. That's the nicest part.
Okay.
Yeah.
Well, are you actually a large?
Yeah, I would say that, yeah, these days probably more of a large. But yeah, that was fantastic. But my girlfriend got me tickets for Hamilton.
Oh, okay.
And so we went to Hamilton on Saturday afternoon.
Right.
And I realised what you do on a Saturday now.
Me? Why?
You are the King of England in Hamilton. Don't even start.
I've not seen it. My wife's seen it. She loves it. And I hear it's very, very good. But yeah.
So we know you've got a singing voice, but I didn't realise that you're also on stage as well. He looks remarkably like you.
Really?
After the first break, I'm going to get a picture up and see if I can get... I didn't take a picture in there, obviously, but yeah.
No, of course not.
Right, so yes, we did that. Then we went for tapas. And we went from the Saturday matinee in the afternoon straight to a comedy club.
Oh, very nice.
And we got absolutely rinsed because my girlfriend decided we sit in the front row. I don't think... It might have been the first time she'd been to a comedy club.
Yeah, you don't do that. It's like sitting in the front row at Panto. You don't do that either.
Yeah.
Oh, dear. Did it take the mickey out of you?
Yes. Quite a lot. So...
What, because you were Scottish or because of your birthday?
Oh, there was various things. We won't go into them.
Fair enough.
So that was my Saturday, and then fantastic football match on yesterday. Our executive producer particularly happy at that penalties result.
You're going to have to tell me what happened because I don't know.
Let's say that producer Fred won't be going to Wembley for the FA Cup final.
Oh, I see. Okay, so we shouldn't mention it to him.
Don't mention the war.
Okay,
no,
mention it.
And yourself?
Yes, ours wasn't anywhere as near as exciting, but a very slow Saturday morning, nice. Don't do anything. I mean, I didn't want to leave the house, particularly because it was so cold. It was still freezing Saturday.
Yeah, was it? Oh, of course it was, yeah.
So we had ice on the ground. I've still got this cold as well, as you can probably see. It's better than Friday.
Oh, yes.
Friday, I am slightly higher in my register than I was on Friday.
I must say the viewers really appreciated you getting out of your sick bed to do that segment on Friday.
Literally crawled to the desk. It really was. Okay, yeah. So then I think we went out. What did we go out for lunch? I think with all the family, and then we went and fed the ducks because the youngest one likes feeding the ducks at the moment. So
excellent. That was actually my job in New Zealand for lockdown, because there's a lot of ducks in Queenstown, and of course there was nobody there to feed them.
Right.
So I made sure I went and bought a.
You went and fed the New Zealand ducks. You're not supposed to feed them bread.
Oh yeah, that's true. Yes.
Rookie mistake there.
Right. Okay. We've done our 4.5 minutes of polite
Okay. Now we
chat.
have to be nice to each other.
Let's go to overnight action. Good stuff. Right, let's go straight to the breaking news of we found out what Monkey Man does for a living. So Monkey Man let out last week that he lives in Sheffield, So now I believe that he is up there in Leeds, opening the Bank of England in Leeds branch. That's a story from the Times today, that only 156 of the Bank of England staff want to move to Leeds, and they're trying to get 500 out there.
Why are they moving to Leeds?
Cost savings. So there's 5,000 people round the corner.
Yes. 5,000?
5,000 people work for the Bank of England.
Wow. And they still can't get interest rates right.
And they still can't.
Right,
Well,
that was unfair. That was unfair.
which takes us on to our next story of, will the Bank of England and why it may need to step in to calm the bond market storm. Straight into it, Chris Beecham.
Yes.
Do we need the Bank of England already?
It's getting in that direction, isn't it? Apparently the Chancellor's very depressed. They were saying over the weekend that because she faces, they talk about welfare cuts and all the options they've given her to try and solve this are awful. Because it mostly involves cutting spending. So she's very, very depressed.
So just from last week, the ideas to make up that 1 or 2 billion additional.
Yeah, exactly. This coming thick and fast is how you send out that message to the bond market if we have things under control.
Yeah.
Because
it needs to be done soon though, doesn't it?
Yeah, and I kind of take sympathy with the view that it's not, and this might annoy some viewers, but it's not 2022 again. It's not the mini budget thing, because this is because two things look similar doesn't mean they're the same. So it's not that suddenly the market has taken, if you like, a dislike to it. It's because of the way that the fixed fiscal rules that UK government's working to mean that they are limited in what they can do. And some people are saying legitimately junk those rules and maybe give yourself a more flexible target, and the markets will be more forgiving. But they kind of see a weak animal in the herd, and they like to pick it off.
And it is the whole herd, isn't it? Because if we take a look at
we're not alone, are we? In terms
current
of
bond yields, we'll move on to the, of course, the big non-farm number on Friday. But if we look at the 10-year in the US there, that's 4.8.
Yeah.
But the 30-year is only 4.97, and that is the big difference.
Yeah.
That is the real concern of a 5.4 30-year yield on the gilts there.
Yeah, and that's the key thing. It's making borrowing more expensive. It's reducing the amount of money the government has to spend. It's putting pressure on companies across the UK economy, and it's exacerbating an already poor situation, isn't it? And that's why you're seeing this weakness in sterling. You've got people like Jim Ratcliffe saying the chemical industry is dying out, so the manufacturing picture is getting worse as well. And it's really not good news for the UK economy.
Now, I did want to do a quick question. If anybody's sitting at home and, likes to play around in shares and likes, got their investments and everything, and they think, why are they so focused on interest rates? What are they talking about with, why does it affect share prices? It's bonds and everything. So I did a really quick example. This might not even be exactly correct, but it's roughly correct. And that is the whole idea of shares, right, is you're investing in future streams of profit.
Yeah.
And those streams of profit, let's say over the next 10 years, have to be brought back to the present day. So I've looked at, if you've got £100 of profit in each of these years, and you're bringing it back to today at 3.5%, which is what we thought rates were going to go to, then in 5 years, that would be worth 84. And in 10 years, it would be worth 71, right? That's what today's profits would be, bringing them back from the future. If you discount them at 5% rather than 3.5%, and that's the real worry, is that rates keep going higher and higher, then look at the difference. You're talking about £6 of difference in 5 years, and you're talking about £9.50 of difference in 10 years. And that's, so that's 9.5%. That's why American stocks are under pressure at the moment. That's why we're worried about UK stocks. And then conversely, if you're a saver, Chris Beecham, those lucky savers at the moment, then I wonder if I can get
those people that love their cash ISAs and that kind of thing,
Sorry, I seem to have.
It's seamless.
What have I done to my
It puts a lot of pressure, I think, on the markets. You're looking at essentially shares not being worth what they were, or not being as attractive, really. And markets are a relative game, aren't they? All the time. It's what looks attractive now, more attractive, less attractive, and of course, those rising rates make shares and those earnings less attractive relative to bonds and other places you can put your cash.
And then, of course, if you put £100 into the bank, I've literally just had an email saying that my Investec 1-year fixed rate savings is up.
Rejoice.
And they're offering me 4.61.
Okay.
Where were we on the 10? Actually, that's for 1 year.
Yeah.
So
that's not too bad for 1 year, isn't it? Given
yeah, 2 years at 4.53, and they're offering me 4.61.
Yeah. So that's not bad.
Yeah, might deal there.
It's a very different world to what it was a few years ago when you had interest rates rock bottom, and now you've got these elevated levels.
And that's it. Yeah. So instead of buying shares and instead of buying those profits that are discounted back and they're discounted back lower, I can put my money in the savings account, and the compound effect of 5% or 4.6%, 4.61, compound effect of those savings is obviously much better than what we were going down to of 3.75.
Yeah.
Whatever. So it's a two-pronged.
Yeah.
Hit, really,
it was interesting for the piece in the FT this morning how the asset managers are turning defensive, and they're just they were saying that the net, can't get my words out this morning. The knee-jerk move last year was just to buy big growth stocks because it was a safe haven, inverted commas, because they always went up.
Yeah.
And now these yields are going up. Those assumptions are being questioned. Now you've got these payroll reports. It means you're saying, well, actually, we don't want to be so much in those aggressive stocks because the risks you're taking, and I know this sounds awfully like what you were saying last year, but that you're taking greater risks to be in those right now, whereas the sensible thing is to come out of that a bit more and into cheaper value stocks and indeed into bonds. So it's a reallocation is what we're seeing, isn't it?
Yeah, which Vanguard are actually suggesting this morning, and that's in the Financial Times. We'll find that in a minute. However, let's just take a quick look at those non-farms. So the big numbers from Friday, there it is, 256,000 jobs. Now, we had a competition, and there was one person that went above 200. I can't remember who it was. Oh, it was me, that's right. So I get to keep my own Greg's voucher.
Oh, did you? I went with 260, so I wasn't far off.
You went with 160.
No, did I go with 160?
You went with 160,000. Look at that, trying to...
Oh, I thought I'd get past you on that one.
So yeah, 256,000, of course, far, way above, nearly 100,000 above where we expected. But also that U rate at 4.1, so that backed it up as well, right? That was meant to be 4.2%. Unemployment coming down rather than going higher. Average hourly earnings were the only thing that stopped the market having a real wobble.
Yeah, could you imagine if that had come in hotter? That could have been a very interesting Friday, to say the least. Even more interesting Friday.
That would have been, but what gave the real kicker was actually later on at 3 p.m. And a lot of people missed this because they thought that's non-farm Friday.
Yeah.
Michigan inflation expectations, as we were talking about on the chart on Friday, on the chat, sorry.
Yeah. Now, to be fair, it's not something you stay up for on Friday, is it, in Michigan? I can't leave the office before 3 because of Michigan confidence. But to be fair, ever so often they throw you a surprise, and that's exactly what you had.
Because that is one thing that Jay Powell, he looks at even more than CPI, is inflation expectations. Yeah. Now, not this one in particular. No. What is it that he gets the measure for inflation expectations? Do you know? I don't think I've ever really tracked it.
No, it's...
Because it's always been
2%,
2%, 2%.
I don't know, off the top of my head. But this is the thing: it's not what inflation is now. It's where people think inflation will be and what their perception is, because that then informs their expected spending.
Yeah.
And if you see that beginning to rise, people get much more worried, and that's the problem for the Fed. I think is sort of a leading signal, if you like.
And then we have to start pricing in higher rates, as we said.
Well, yes, this is the thing, isn't it? It's not just about. I think they're pricing 50 basis points for the whole year or something now, if that.
Let's take an exact
certainly in the second half.
Look at this. So December, let's go straight to December. There's a 31% chance we don't have any cuts 31% chance we have no cuts, 40% chance we have one cut, and that is now far and away the most likely scenario.
What was that a week ago? What does it say down the bottom?
Yeah, that was, now we go to
Sorry, I should just look this up
compare,
myself.
don't we? Yeah, there we go. So,
Looking it up as well.
32. All right, so that's the one that's moved. Well, let's keep it basic. Let's look at March. March, you can see there. So the latest chance of us, that was the 13th of December. Yeah. So we're coming down this way. So that was in the past. The expectations were at 52%, and they are now 21% of a rate cut by
A week
March.
ago, that hold was at 16%. So now that has doubled, if you like. But that, of course, that's not the thing you should be worried about, is it? It's what happens on the right of the graph when the potential for a rate hike starts to creep into the picture. Which, if you get another couple of slightly hotter CPI figures, that could be interesting to watch, is the probability of that having to come into the picture.
So, yeah, there you go. For June, for a rate hike at
there
this
she
moment
is.
in time,
There she blows.
0.67.
There's your one to watch the
And
next
that was
few
in
weeks.
December. Wow. Like December, December, it's still 0% chance.
Okay.
Wow.
So the market's doing its thinking at the moment. That's the interesting thing, isn't it, from Friday? You're seeing the market doing its thinking in real time. And we're beginning to maybe see a few people just thinking about the possibility of a rate hike.
Yeah, right. Let's have a look at how the markets are set up this morning then, because it's not going to be a pretty start for you bulls. S&P 500 down 40 basis points already. Asia did not react well to the numbers. That's hit the futures down while the Americans have been sleeping. NASDAQ looking down 60 basis points. Oil up 1.2%. Now, that's because the US has put more sanctions on Russia.
Which is interesting, really, because, well, surely we should have had enough sanctions on Russia by now. But also, you've got an administration that's days away from coming into power that has promised to drill and drill and drill again.
That's it. And producer Fred just pointed out it was also up 3% on Friday as well.
Yeah,
So
absolutely stellar run. I suppose because the payrolls numbers were good. If the US economies continue to roar ahead, then it's a really, really good sign for oil prices to give us the boost in demand that really oil has been looking for months. And that's the reason why it's been so poor, is that you've got all this supply, but also because the demand picture was looking weaker. But now look at it, where you've got oil back at 77 now for WTI.
yeah. Now, okay, that won't come into the CPI this Wednesday.
No,
But there is only really one number that counts this week, and that is 1:30 p.m. on Wednesday, when we get that inflation data out of the US.
And that will be the key, isn't it? That's the event of the week, particularly. You get UK data as well, so that's interesting. You get US and UK data on the same page, on the same day, rather. So that'd be really, really, really key, especially if you're watching sterling at these current low levels versus the dollar.
Yeah. Now, that takes us perfectly onto sterling. Let's see if we can get sterling up, because that is not looking pretty either. 121. Now let me just see. Yeah, 121.20 was the last time I saw it, I think. And we are now. Where's my sterling gone?
So it's the lowest level, back below 122 for the first time since November of 2023.
I don't even want to get that chart up. It's so horrible. That is just. Oh. Now, the Bank of England, what options do they have? They could pause QT. That might put a bit of floor under it. Rachel Reeves could come out and actually make some comments.
Well, yes, because she's not been seen, has she? This is the key. She's been in China. She's been on her trip that generated $600 million worth of investment, which is nothing.
No.
Really?
No. not really worth
Not
the
really.
business class
No, it's
flight,
not
is it?
really worth a flight all that way, is it? So, but yeah, she had the Deputy Treasury Minister was out in the Commons last week talking about the gilt market, and not in a way that really inspired confidence.
No.
I think it has to be said. His markets go up and down shocker comment, really. Prices move around.
Yeah. And it's not us, it's the whole world.
Yeah.
Yeah, Funky Gibbon, the pound fallen again, the impact of the US really causing us grief. That's right, and is the bond market starting to take the printing press away from Rachel Reeves?
Yeah, the pressure's there, isn't it? It's you don't have the license. I think it's the lesson from the lesson people took from COVID was you could print more money if you needed to support the economy, and then people thought, well, we can do what we like. And as Liz Truss's budget proved, you can't do what you like because the bond vigilantes are still there because they will take his shit.
It almost helps Reeves this time that Truss went through that because they know exactly where the limit is, where the border is of what they can.
Yeah, exactly. So it does mean that you have something to work with, if you like, and a pattern. But it's not a fun place to be.
No. And if that CPI number comes in hot.
Of course, a falling pound is essentially a rate cut for the Bank of England by another means as well, because it's importing inflation, it's loosening monetary policy by another means. And that means that you're also likely to see higher inflation in the UK, which piles pressure on the BOE at a time when they really do want to be cutting rates, I think. And I thought this was that they'd have to cut more in 2025 than people thought they would. But it's going to be really hard if you've got inflation remaining resilient thanks to a much weaker pound.
Oh dear.
So you need those 5,000 people to work out the answer to that.
Yeah, that's it. And especially some of them up in Leeds.
Yes, yeah.
Right, here's the message from Vanguard that we were talking about. Asset managers turn to defensive positioning as equity prices soar. They are suggesting that now calling for financial advisors and certain wealthy individuals to allocate 38% of their portfolios to stocks and the remainder to fixed income. That's down from 41% in 2024 and 50% in 2023. So flipping around the 60-40 idea, 38% stocks, 62% bonds now.
And this, how often do they change that? Is that
only annually?
Annually, okay. So that's the problem, isn't it? If you had a big, let's say the market dropped 15% tomorrow, would that 1987 style, would that recommendation still hold? Would you have to start changing again? But
that's the problem, isn't it?
They're doing it once a year. But it's a fair enough comment to make, and it really reflects the caution. I think it's a reflection of how well stocks have done, more than anything else. And the fact that, as you've been saying, the bar for US equities is now so much higher. The level at which you have to keep doing well is going to be much higher. And this is what we saw in last earnings season, was if you missed earnings, you got punished. But if you met earnings expectations, you didn't do very well either.
No.
And with earnings season kicking off on Wednesday, CPI and JP Morgan, Super Wednesday. Can we call it a Super Wednesday? Because since everything's a super, if more than one thing happens on a day, it's a Super Thursday.
That's right. That night in London, 2012.
Yes, exactly. So that's going to be really interesting to watch as the forecasts come through, where they think they'll be in a year's time, how that will put pressure on stocks at the moment.
Right. Okay. So that was the Vanguard. Now, okay, some positive news. We've been very gloomy with futures down 60 basis points. It's not too hard. But what about the class of 2025? The IPO hopefuls that could still come to London, no matter what our gilt price is, no matter what our currency is. What are they going to be? Well, we're looking at eBury in fintech. So that is Santander, and that is a group, only 2 billion sterling, but that would be an IPO by Santander. Then Zopa, which is one of the SoftBank backed.
Peer-to-peer lending, isn't it? Yeah.
Peer-to-peer lending. ClearScore, credit checking. Then you've got another couple of financial services. Then industrials, you've got Metlin. Now, this is the mining company currently trading in Athens. And there's been some talk about that for the last few months. Air Baltic, the Latvian flag carrier.
Okay.
A Monday, isn't it? Did not expect to be seeing Air Baltic. Could get a bit of a frosty reception.
Oh dear, dear. Chilly wind on that one.
She in? Is she in or is she out? That's the one that we're waiting on there. We go back up to the article, please, guys, just to get all the details there. She in, so that is up to 50 billion. Then also Unilever ice cream, another one we'd be worried about a frosty reception for.
Yes. Plenty of churn in that stock as well.
Oh, very good.
Yes.
What kind
That's
of?
interesting, isn't it? The Unilever ice cream that they're spinning off that division. Why are they?
They've actually been trying to sell it.
Ah.
So that's one option would be to sell it. One option would be to list it.
Are they going to skim off the top? Is that the idea?
And there would be some skimming. Yeah, bit of. Hope there's no flakiness in that one.
Good.
Andrew McKelvey saying MDZ. That's one to watch today. Not one that I've heard of. Now, and Plus has added to its customers and likely will result in a +2. Now, what Plus is that? Is that Canal Plus? I would hope so, but I'm imagining not. Right. Okay. So 7:56. We'll go to a quick 1-minute break, and we'll get the recommendations for you, upgrades, downgrades, and then we'll be back for opening bell.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Welcome back, everybody. So we are having a look at the indications. Now, we are looking at N10 up 5% this morning. N10 up 5%. Expected EBITDA to be top of the guidance range. And Whitbread looking down 2%. So weekend press reports is that Rachel Reeves is looking at a hotel tax. I mean, I've heard of a bed and breakfast before, for end of tax year, but that's
designed to make everyone even keener about going on holiday in the UK. So when you go to Rome, isn't it, and the places there, and you pay, and then they go, oh, by the way, there's an extra tax you have to pay.
Yeah,
a kind of city tax.
And I imagine Barcelona probably about to start the same thing.
Yes, where they're not hating tourists. Yeah.
Now IHG down 2% as well on the back of that. Plus 500 must be what Andrew's talking about. That's looking up 3% on full year revenues, 786 against 727. And that's Page Group down 2%. Q4 trading remained weak. Full year operating profit to be lower. Now, that's how are recruitment companies making money?
They are just, it's a string of bad numbers from them, isn't it? The mood music from them, from Page Group, and the names now, I can't think of the names, Hayes, that kind of thing. It's just
Starts with R.
Yes,
European one.
Randstad. Yeah,
Randstad.
It's the poor backdrop. There's no confidence. The people aren't moving jobs, this kind of thing, or people aren't hiring particularly.
And the temps are the first one to go, aren't they?
Yeah.
Like myself.
Oh, I'm sure we'll find a use for you at some point.
That's
Maybe you can feed the ducks on the Thames.
Yeah, exactly. No, dog walking, that was the other one. Right, and also drilling results continue at OMI. Andrew pointing that out as well. Right, so we are 30 seconds away from opening bell. What are we going to be watching on the open? Well, FTSE down 25 basis points now. Is the FTSE going to get the benefit of that weakness in sterling?
Or is it going to be more, take its cue from other global markets and just continue to fall? Because it looked a bit toppy, really, the last couple of days.
toppy.
Well, it's got
Not
back
in dollars, it wouldn't be.
Well, if you want to price it in an obscure currency, it's fine.
Right, let's kick off this Monday. That's not looking great for S&P. But if you are trading long FTSE, short S&P, then it is looking interesting for you. Right now, Vodafone under 60 pence. I see it's open there. Vodafone under 60 pence. BP up too. So BP, the winner of the morning. Wow, the FTSE has got off and running quickly. There is no delay in that. We've got Porsche up 2% in Europe.
Motoring ahead. Why? Is there a reason why?
No, but it certainly, that's, 2% for BP.
So oil
Shell up
prices
1.7. The gambling stocks up on the back of Entain numbers.
Yeah, very solid.
So Flutter up 1.8. The banks as well up. Wow. Okay.
Holding up. Okay.
Yeah. So what's taking the FTSE down? Well, it is Diageo. Yet again, 24.16 trading down 1.3, even with the benefit from sterling. IAG down 90 basis points on the back of that potential hotel tax. GSK, the defensives down 60, BATs down 80. So yeah, that just feels like a bit of a markdown, doesn't it?
Yeah, I think it's a cautious open. The urge to go bargain hunting after Friday's action is probably very strong. But with, obviously, you've got your very little breathing space between payrolls and CPI before.
It's a brave man that takes a big exposure ahead of that CPI, isn't it? Because that could really set the ducks amongst the pigeons.
Ducks, pigeons. I'm not quite sure we're on the right page there. What are we expecting for CPI Monday? Just, okay, 0.3 in US CPI, 2.9 year on year. Okay.
2.9 year on year is expected.
Yeah. From 2.7, yeah.
Right. Now, ESAR was pointing out that the instant, what's the instant calculation? One of the local authorities in
GDP now?
Yes, but for inflation now.
Oh, okay.
Yeah, so that was pointing towards inflation actually coming in higher. And
Right.
that's the first time he had seen that in quite a while.
Oh, okay. Look that up.
Right, ASML looking down 1.6 in Europe. The airline's taking a bit of a hit, down 1.4. That's, of course, because oil going higher. Let's get an update on those risers in the FTSE. Yeah, Shell and BP not quite holding that. £4.30 on BP. What a bargain down at £3.80.
Yeah.
Only
If only you'd known.
2 weeks ago.
That's mad, isn't it, really? This is a recovery for BP after a miserable year. So an absolute storming performance.
Yeah, really miserable. Actually, let's take a look at back. JD Sports up 1% ahead of numbers this week as well. But let's take a look at BP's resurgence. My goodness me, somebody's really... Yeah, I think we don't get a chance to look at that because... There, that's better. So that is the year to date. That's got to be one of the best performers. And then, yeah, we go back that far. There we go. So there was £3.80 on the 23rd of December. You could have already had 15% out of BP.
What was the yield? I mean, what the yield on that must have been even better than it is now, but still.
Yeah.
Yeah. Find out. What's the current dividend yield of BP? About 5.5%.
5.5%, and you've had 15% capital appreciation.
Yeah. Take your money, go home, you're done for the year.
Yeah, exactly. Well done.
There's what you should have done at the end of the year. Thank you very much.
Yeah.
Come back in a month's time to find out what you should have done today. But
Well, let's answer that question now. What should they be doing today? Well, we've not given advice or anything, but it's certainly, yeah, being very careful of buying the dip. If you're buying the dip here, you're going against the economics. You're going against positioning because, you know, position is not equal at the moment. There are definitely, we're on the long side of historic positioning in the US, especially in retail. And you're going against the, I guess, warning of playing over a huge number on Wednesday.
Yeah.
So the temptation, yes, it is to buy the dip because we see it already 5,800 in the S&P 500. Your target's 5,680. We know that because you've said it. Now, if there was a dip down there, that would be tempting, wouldn't it?
That would be very tempting, I think, particularly if you saw it, if you went down there. But I think the key with buying the dip is not to be too early, which sounds incredibly trite, but so many people will just, oh, it's gone down a lot. Yes, but it hasn't finished going down.
Yeah.
And that's the thing, markets, as you can see...
It only started going down, really,
yeah, it's only
1:30 p.m.
Yeah,
on...
precisely. We're still very early into this. If this has another proper pullback, we've got weeks of this.
Yeah. Today will be very interesting because people definitely bought the dip on Friday. So, you know, you've got a lot of American fund managers that aren't necessarily, you know, that global looking. And you've got a lot of US retail that, you know, are very keen to buy any dip at all.
Overly keen, you might say.
Overly keen to buy any dip because, let's face it, they've been right and they've made money from buying the dip. So there we were at 5 p.m. after the Europeans puked their longs on the European close and all the derivative guys had hedged. Then we had a huge bounce of 60 points in a straight line, and then it sold off again, let me see, to close at 58.20. So now all we're doing is trading exactly where the low was on Friday at 5 p.m.
And that's the key, isn't it, to watch, is if it does recover, how much strength has it got in it? If it claws its way back another 60 points, what happens when it gets up there? That's the most important thing. Because you could buy it here and make a quick, it could rally fair enough on a Monday. People feel a bit more optimistic. But then what does it do after that? That's the thing. The dip hasn't finished dipping yet, I think.
And to put it in more eloquent words, Art Cashin, God bless his soul, R.I.P.
Great man himself.
The king of the New York Stock Exchange, stocks never bottom on a Friday.
So very, very true. Very, very true.
So we'll see that. Wow, Entain. Who out of you has Entain? Up 8.8%. I would not have bet on that one on Friday.
That's what I love about trading statements. You get one line and the stock surges. You get huge RNSs with full year numbers in it and it moves 1%. And you get one line that says, we did all right, actually. And the stock goes up 8%. It's
That
great
really
fun.
is. Now, remind me who Entain was before.
Oh,
Was that William Hill?
I think so. I struggled to keep track of who they were and who they are now.
GVC.
That's it. Not
Entain.
QVC, that's the shopping channel.
Yeah.
BWin, Coral, Ladbrokes, Party Poker, and Sporting Bet. So yes.
Oh, it was Ladbrokes.
Yeah.
Right, okay. So, up 9% now. Now, that does come close to a stock very close to my heart on Friday. Walgreens Boots, up 28%. I bought call options for a bid, and the call options have almost come into the money just from a set of numbers. That was absolutely unreal.
What did they say? What were the figures?
Well, they were going to meet guidance. That was good enough because the stock's on 5 times earnings. So up 28% it went. It was the real winner. Forget non-farm payroll. As you can see from this graph, there's Walgreens Boots Alliance. Now that looks a heroic share price appreciation, but let's put you onto the daily and you'll see that it is merely a,
Here's a bit of a scratch.
yeah, back to where it was. Back to where it was in July, actually.
Okay.
So if this gets bid for, then I'm thinking it's around the $15.50, $16 level, and that's where my puts are. I've got the $12.50 calls up to the $17.50.
Right.
But only February expiry, unfortunately.
Which only takes you back to 6-7 month highs, isn't it? It's crazy how
That's right.
the damage to share price is mad.
Yeah. So Sycamore, I think it was, that we're touted to be looking at taking them private.
Right.
Talks are ongoing, it sounds. David Faber, CNBC, but the people he's talking to there are problems.
Right.
Obviously, with a company that share price has done that, it's not going to be a clear.
$97 a share back in August 2015.
Oh, what a destruction of value! Is that when they bought Boots?
No, it was long before that, wasn't it? When they bought Boots?
Was it Walgreens that bought them initially? Did they not go private equity?
Yeah.
And then they came back on the market, and then they went again. Because that was 2006 that they first went private.
45% stake in Alliance Boots in 2012.
2012, right?
So
Great.
joined the Dow in 2018. Kiss of death, if ever there was one.
Right, our partners across at Numis have already put out a note on Entain, saying that they've maintained guidance along with some optimization in marketing spend, benefiting from a lower sports betting mix than Flutter. Ex-US has benefited from favourable results in the English Premiership because everybody bets on Man City. So obviously that's been beneficial for them. And now sees group EBITDA coming in the top of its guidance range, results in a modest EBITDA EPS upgrade for full year 24. No read through to full year 25, because obviously unless you're going to bet on Arsenal getting beat, then you wouldn't know the results yet for 25.
Was that just a gratuitous?
Oh, he's left.
Oh.
He's gone. Right, reassuring message for Entain after a period of downgrades, should go modestly better.
Modestly?
So yeah, that modesty is... now, we've got a bit of... what do you say when the troops are going against you? Is it insurgents? No.
A rebellion?
A rebellion. We've got a rebellion in the gallery.
All right, Lord Vader.
The gallery think that my Greg's position was such a crap position, and I did actually cut someone on Friday afternoon at 21.36. They think my position is so crap in Greg's that they've actually started their own demo account, the two directors out there, and the stock was trading 21.50 on Friday, and he put in a bid at 20.76, and he said that's going to be the bottom of Greg's. He just got his stock. So the gallery is now long at £20.76 of Greg's, and I'm long at 22.22. Oh dear. Let's take a look at what is causing me the pain there. Look at
miserable week
of sugar.
Poor old Greg's. I mean, it's hard to understand it because they're so, well, they're everywhere, aren't they?
Well, there's 2,300 stores, 2,600 stores is their target. Now, a drop from 28.37 down to £21. What is that percentage terms? It must be, what, 28? Well, it's dropped £7.30. So it's not quite 30%, is it?
No.
No.
From that high of September?
No, that high on the 8th of January, Chris Beecham.
Oh, okay.
The 8th of January, this stock was trading £28, and now it's 21. So I have just bought stock at 20.76. That's the stock I cut at 21.50. I'm buying it back. 21.30. Buying it back at 20.76. But that is a painful one. That is a painful one. But the gallery going against us. Let's see how they get on. Who's your money on? Is it on the gallery demo account, or is it on the guy who's been trading for 20 years? Because at the moment, they're winning.
You've got to admire their front in a demo account, really. Put their money where their mouth is, in Greg's case, quite literally, but yeah.
I must admit, I'm quite impressed with that. So, right, we've been through the S&P 500, we've been through BP, Sterling currently trading 121.57, a little bit of off the lows there, let's say. We hit the lows at 121.12. We're now at 121.60. Andrew McKelvey has Entain. Excellent. Well, it might not have been great long-term position, but it's certainly a good way to start a Monday. Long may the week continue in that form. So Angeline's going to be coming on in 5 minutes to give you some confirm and send questions, Chris Beecham.
I should try and be on good form.
But my question is going to be to you,
right?
A what if? Right, and we're going to start with what if Well, I'll tell you what, I'll ask you one, you can ask me one back. So my worry is, of course, what the CPI is going to be.
Right.
Right. Now, you said the expectation there was 0.3. So let's take a look at this. Core inflation expectations, 0.2 to 0.3 on Friday. The previous was 0.3. And then the headline is 0.3.
Right.
2.8 headline, 3.3. What if that CPI comes in at 0.4 and a 3.4 on the core?
3.4. Then it could get nasty. I think then you get another worry, because that confirms what you had with Michigan and ISM data last week. The prices paid figures were also very strong.
Yeah.
So it just begins to build that evidence that inflation is moving out of the stubborn phase into the next move higher. And I don't think markets were very happy with that.
They will not be best pleased.
No, to put it mildly.
However, and that is my positioning, right? I am generally in either cash, bonds, gold, and got downsides, right? Because I have been very opinionated on where my feeling is on America. However, your retort back to me, Rich, would be, what if inflation comes in lower?
Yeah.
Then suddenly we've got a booming jobs market and we've got inflation that's under control. That, I mean, S&P probably up 4% on that, isn't it?
It's a very powerful combination, yeah. But even now, I just think there's not enough juice in the market to react in a massively positive way. I think people are still in that, okay, it's okay, but do you want to chase the market at 30 times earnings?
But bond, I mean, you would aggressively buy the long end, wouldn't you?
Yeah, exactly. Be very expecting a resurgent growth picture.
Yeah.
Because he's managed it really, really well. And look, Powell's done really, really well of his positioning in terms of how the US economy has performed. And that's the message of Friday's numbers as well. Is that you're getting a strong job market, but you're not getting the growth in wages at the moment to go with it. So on the face of it, from Friday's numbers.
Until, for example, you maybe come in and put up tariffs and cut taxes.
Well,
and,
yes.
And then,
yeah. Let's say
this is problems before we've even started on Trump. So
you haven't even mentioned him this morning, I think.
Yeah, thank goodness
we're almost all the way through.
Good stuff. Right, we'll go to a quick break. Angeline's going to be come back in to quiz this man here in front of me.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Hey, trader friends, welcome back. It is a bright and fresh and frosty morning out there when I was running in like a crazy person across London Bridge, but it's all warm and cozy here with Chris Beecham.
It has warmed up now. It's very cold when I came in the office.
It has, but my hands are still freezing.
It's Baltic.
For Christmas, I got this wonderful thing called an ukupa, and it's like it's a hand warmer, but if you're not using it, it can also be a battery bank for your mobile phone.
Oh.
Really great.
It sounds like a small furry animal.
It's smooth, actually. It's like a pebble. So yeah, heads up, people out there. Ukupa, really like best thing.
Can you use that in a sentence?
No. Speaking of using in a sentence, we've got some really interesting and clever questions from our viewers. Let's hit the first one up now. What do you expect from the forthcoming US earnings season, Chris?
Well, if we're looking at these are Q4, so it's the last 3 months, 2024. FactSet, which are the people I always follow, the earnings growth rate is expected to be 11.7%. Now that, if that comes in that way, then you'll be the highest year-on-year figure reported by the S&P since the final quarter of 2021. So really, really solid performance. The problem is, as Rich and I were saying, it's a very, very high bar. And I think if you've got, again, these jitters about inflation coming through, companies that just meet expectations, don't beat them, are going to be, I think, suffer. Notably as well, you've had so far about 70 companies have issued negative earnings guidance, which is above the average.
So essentially what you're saying is if they just meet and they don't meaningfully beat, they're just going to get whacked.
Yeah, because you're looking at a market where everyone already owns US stocks, so it's hard to find the newcomers to the rally in the short term. Exactly. Yeah.
Thanks to Andrew McKilvey, over the weekend I had a look at my 5 pension funds, which I'm trying to consolidate because I've already moved 3 over to Fidelity. One still stuck with Prudential, terrible. Another one, St. James's Place, high fees. I did notice that, yeah, my holdings are kind of like 70% US stocks.
Well, that's just what they are. That's 70% of global market cap. So it's aligned with the benchmark. But yeah, you are. It's made sense to be long US over the past 15 years. And I don't think that rationale has changed long term. But in the short term, I think you might need to brace yourself. Don't stroke whatever it is. What have you got?
The ukupa.
That's it. Bless you. Don't hold on to that.
It's good for an organist, you know, cold churches and stuff like that.
Yes, I just sit on my hands. It's sometimes.
Oh. I'm not going to say anything about how warm other regions are. Let's have, also, whilst we're on earnings, the US banks, of course, are going to give us a kind of good curtain raiser, a peek, if you like, as to how things have been.
It's the first time they've reported on a Wednesday and not on a Friday for several quarters.
Yes. Do we know why?
No.
It's not like that, one of those rhymes where, like, what is it? There's a US rhyme when I was working there. Jobs, always on Friday, unless something Michigan PMI was not on the Thursday before.
Right, I'm not sure you've got this one down.
There is a rhyme. I will find it for you. If you guys know, please put it on the chat. But there is a rhyme out there as to why sometimes jobs don't come on the Friday. It's very rare, but That's something to do with either PMI or UMISH. Right. Hit us up with the next question then. What does the rise of UK gilts mean for house builders and other sectors?
Well, if you're talking about, we're talking about rising yields, I suppose, at this point. It means fundamentally that we're seeing a much gloomier picture for the UK economy. And I think house builders, we saw this last week, UK banks got very hard hit. UK focused banks got very hard hit. And the natural read across from that is to house builders and to say, we think they'll also do more poorly because people aren't seeing as increases in the income in the same way. And that's putting pressure on people moving house or trying to find new homes. So I think it's a much gloomier outlook. But everything UK connected, and that was the key thing last week. It was the FTSE 100 did okay, and it was the 250 where the selling was really concentrated because it was people focusing squarely on the UK and saying actually the outlook is much poorer. And so yes, house builders, it's not going to be great. And if you've got a falling pound, of course, inflation's higher, which means the input costs go up, which bears on their margins. So it's a very, very nasty cocktail.
And Donnie One and a lot of our trader friends talking about this today, Gavin, another one of them, and they were saying that, you know, all this just means, I agree too, I concur, the kind of feeding into that bearish sterling for longer picture. And we talk about this a lot here, Rich and myself, you know, gilts, bonds, that is just like someone with a magnifying glass for the near term, bit more longer term binoculars, and for the UK it's looking pretty.
It is, it's looking
pretty
grim all round.
Yeah, and I guess the other thing too is I saw Luke Moore send out one of his market sort of heads up earlier today, and there was a really interesting key figure there. 2024, one of the worst years for UK property owners in terms of a rise in property price.
Okay.
But yes, it all kind of, the question is, does this then with the weak pound hopefully feed, do we have any statistics that show it feeds into more M&A action, you know, perhaps
yeah, I think it would also,
exports get much better.
it would help exports. So that's the thing, the FX market, it's a double-edged sword. So yes, it increases importing inflation, but it does at least make UK exports more competitive, which does help the economy. So there's a balancing act to be found. It would also mean, yes, if the pound continues to fall, those UK companies that people are looking at have just got cheaper from a dollar, from a euro perspective, which does make them more attractive. The problem is, I think the mood music at the moment is so dire that people are just going to have to wait and see, because it's cheap, but it's cheap for a reason.
And here we are. Heads up for those of you who are about to go on holiday and you spend and earn pounds, look at my weekly chart and don't weep. Don't weep. But as you can, heard from Chris here, it's looking dire out there, and it has been for a while. Do you think that I've drawn Angie's yellow lines there? You think the bottom one might be one we are going to reach quite soon? This is the weekly chart.
Heading in that direction, 120. Everyone loves a nice round number.
Yes. I guess the key thing here too is, are there any glimmers of light out there that might pull sterling out of a hole?
Not yet. No. I think you have to wait for things to turn, and we're not at that point yet. I think you need the government to come out and make some kind of statement.
The gallery is saying even Rachel Reeves is depressed.
Yes. Yes, she is, poor thing. This was the comment of the weekend. Rachel Reeves is depressed because all the options you've been given are bad. And you can imagine how that's stacking up in the Treasury, because they're facing welfare cuts, all this kind of thing. I think it will get worse for Labour in terms of polling as well, just from a political perspective.
Taking a look at my watch list, I have a UK builders watch list as well. There are some of them higher today, but if I punch up some of these shares for you, you can see the kind of pain that some of these companies. Let's have a look at Taylor Wimpey as well. That's a big one. There we are, heading up. Taylor Wimpey for you. This is the daily chart there. Look at that slide since...
It's brutal. It really is.
September.
Now, of course, it makes them attractive valuation basis-wise, but they're just not seeing the positive news, I think, to turn that around. So it's one to keep on the watch list, certainly from a fundamentals perspective, even if not from a trend. But you have to wait for the moment. I think it probably is a bit early, really.
Good one, if trader friends, if you like shorting, because this one, could be one that you have been shorting for some time or looking to short. Let's have the next question, gallery. Can we expect international groups to expand operations in the US to avoid the impact of tariffs? I love questions like these.
Go on, then you answer.
I mean, like, but if we talk about international groups or maybe even companies, pretty easy to move operations of like an EV factory, but really hard to move like a pig farm, for example.
Yes.
Agriculture is very...
Certain groups much easier than others.
Yes.
It's much harder to do. This is, yes. But Rich and I got through about 50 minutes without mentioning the orange man. And I think we're about... but it is...
Are we still on that? Are we not mentioning the orange man? Are we?
Well, no, I think now we've broken the seal on that. I think we just have to admit that we are now a week away from the inauguration. And yes, it's about appeasing the Americans at this point. It's about appeasing him and finding ways to work around this. And so, yeah, you get a lot of companies reshoring. Isn't they call it reshoring? Is it reshoring if you're a European company? No, I suppose you're not. That's technically offshoring.
It's technically offshore.
But yes, that will be, I think, the key thing, which you could argue feeds more into US strength, US exceptionalism, if you want to put it that way. But people trying to sort of keep him happy is going to be the key feature, I think, of the next few months.
Who was that famous cartoonist that's recently been, I mean, she handed in her
And something
because
or other.
They would not publish her cartoon. It was...
Yeah, and... Oh, it's
going to really bug me now. Trader friends, you guys know this? There's news over the last...
the Washington Post cartoonist.
Yes. And what was the cartoon? It was the orange man and all the...
You could see the tie and the bottom of his stomach, and it was the tech guys doing homage, as it were.
But what I found really funny out of the whole picture was that on the side it was Mickey Mouse as well.
Yes.
We'll try and get that picture for you. I mean, the other question, of course, is that it'll be interesting for how long this homage, if you like, goes on for before, cracks appear and then we start seeing...
Things go both ways. It's the pendulum swings, and at the moment it's swinging his way. We'll see how far that goes, really, how that plays out with the user base, particularly.
And also the politics elsewhere. I mean, there have been many reports, including those in BCG, as to whether it might push China to then deepen and hasten its ties with much of the rest of the world to, whilst that dynamic is playing out.
Yeah.
What does this mean for trading? Some of our trader friends are asking, I mean, we've talked about the strong dollar a lot here. Might that wane from the second half onwards? Are there any key indicators that you're looking out for that might signal that we are, at a pivot point?
Well, I think we're anxious to see how the dollar fares once Trump gets in, because as Brit and I have been saying before, he likes to talk about a strong dollar, but ultimately he wants US manufacturing to do well. So he'd like
a weak dollar.
Yeah, a weaker dollar in that sense. You can't have your cake and eat it, to borrow from Boris Johnson. This is going to be the major question: how much of this can be sustained, this dollar strength? And if you start to see that turn lower, maybe that's the chink of light that people are hoping for. Certainly for the pound and the euro, because they're talking about parity for euro dollar. And usually when people talk about parity for euro dollar, it's kind of a sign that the move's almost done and you get a bit of a bounce. It's tough to see at this point, but it's definitely one to watch.
How much time we got, guys? A minute. I'm going to show you this. If you like maps, like Chris and I like maps.
A map and a half.
BCG has a handy map that tries to paint a picture of how trade flows between nations and regions will change by 2033. Of course, Chris Beecham will only be probably 35 years old then.
Still 17.
Still 17 in your...
my laptop has started to restart. We love it here at IG. It's so super secure that when you least expect it, your laptop does a forced restart to update.
I had it once at the beginning of a webinar, and it just meant that I was locked out of the webinar, and the webinar continued on without me, like the runaway train. It was great. I couldn't actually get back into the webinar to stop it. It was not fun.
Oh, wow. What happened in the end?
I think we managed to jump on board to somehow sort of press the stop button.
You latched onto the
Yeah,
runaway train.
yeah, exactly.
But that screen, which I'll share once my computer finishes restarting, is the BCG, how will trade change. And they've done a very clever depiction on a map with arrows and green lines to show how trade is changing direction and by how much. And this is on the BCG site. Right, so we have to go. What is the rest of your day looking like?
Podcast recording later with Aaron, so we're looking
What
at
is the topic?
economic data, I think, is the key and how important it is for your portfolio.
Nice. I will be watching because I'm currently rejigging my pension fund, which is 70% heavy US stocks. On that note, we will see you up next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Hey, trader friends, welcome back to Trade Expectations with myself and Jack McGuire. Hey, Jack, how was your weekend?
It was very good, thank you. I was out and around, met a few friends. Some friends from home came down, so it was nice to see them. And then yesterday I was working on our weekend dealing shift, so I was sort of the whole afternoon just pricing markets on the out-of-hours session.
Nice. Now, we were both online and watching the action on Friday, weren't we? I mean, it was unbelievable. Just let's have a quick chat and try and show some of trader friends who may or may not have been trading at that time what that huge initial reaction was. It felt like good news is, again, now bad news.
Yeah, so quite a bumper number, to be honest. I don't think any of us were expecting it to be that high. And then obviously we get a massive reaction. I mean, going into it, we had pretty high implied volatility across different markets. FX vol was pretty substantial. And then the same goes for the US, and we build up as we get closer to that number. And then quite a lot of that came out. Sometimes you don't get the same sort of reaction of IV translating into RV, but I think we definitely got the move that we were expecting on Friday.
Yeah.
I can show a chart, actually.
Okay, let's have it. Or my computer's back up and running now that IG's done its security firmware update. So I can also show a quick snapshot, guys, of, that was on Friday during that NFP number. Jack, you want to show your screen?
Yeah, I'll show you mine. I've just got the S&P up, so the US 500 that we see. And you can see the reaction on the number with that massive, very sharp move down. And then we actually get the trend continuing through the evening, slight reversal, but then even into the close, we get sort of that similar downwards movement. And it's similar on some of the FX pairs. I'll try and find.
Yeah, here's the cable. I took a snapshot on Friday, so there's a look at cable for you. Look at that huge move there upon that very, very high NFP number. So crazy moves out there. Jack, do you think this might mean that the following months NFP might actually be lower than expected? Sometimes we see that sort of recalibration.
Essentially, yeah. I think it's going to be interesting to see how the market perceives any of the upcoming numbers. I think we saw some news coming out when we got the number on Friday that the sort of forecast for Fed cuts coming into 2025, I think that's where the market starts to actually move properly. When you get a number that makes the market have to recalibrate those assumptions about when we're going to get a next interest rate cut in the US, that's where we see a big move. It looks like from the number on Friday, we're now expecting there's not going to be any thought of a cut before June at the earliest. If we get another NFP coming in the upcoming months that can recalibrate that, I think we might get the same reaction. If not, I don't really see where that's going to come into. But it seems that the labour market is just so resilient at the moment, and it's not really getting the sort of impact that you'd want from rate cuts for the Fed to feel confident to bring those interest rates down.
Look, we've got CPI, of course, a big, big number this week. And then we've got earnings kick-starting the back half of the week. In terms of volatility, what are you looking out for?
The main event for us on the options desk this week is definitely going to be CPI. There's obviously different figures as well. It's mainly the US and the UK this week, so we get inflation data, growth data, which obviously is going to be quite important for the UK to see with that negative growth last time round. And then there's also retail sales. So these are all going to feed into basically the health of the economy and where inflation is going to be most impacted by and how the economy is actually performing through these times. I mean, even today, we don't really have any figures of note happening that are going to prompt that volatility to get higher. We've still got an SPX straddle of 45, 46. Crude opened up at the open last night, and we've got a very, very high volatility there. Obviously, we get further sanctions on Friday. It seems like since really mid-December, the volatility's come into markets and it's stuck around. So even when you're not getting these prompts, you're getting very high volatility. It's a lot of opportunity there, really.
Yeah, vol is certainly coming back. And also, I mean, this is WTI, this is crude looking like risk on day there for crude. It's marching high. This is daily chart, but let me show you the 10-minute chart there. That'll give you a better idea. Yeah. It's you know, the other one that's been a big mover so far this year is also natural gas, up more than 2% as we speak. The natural gas, a lot more volatile. Those of you that watch this space. But on the weekly chart, it is looking like a strong uptrend since August last year. And also it's punched past the resistance at around 3,700, 3,700. Let's take a look at the daily chart to see whether or not that pattern holds. And it is also in an upward pattern, a trajectory since around August. But like I said, more volatile than WTI and Brent there. Let's just take a look at some of the chat on YouTube. Lots of people out there talking about gold, asking about, you know, what's going to happen with gold, and also expectations for the earnings season. I just had Chris Beecham here with me, and was saying, really, this coming earnings season, Jack, if companies only just meet, but they don't beat meaningfully in terms of their earnings, then there's going to be disappointment. Do you share this sentiment, or do you think that overall it's going to be quite a positive, benign earnings season?
I mean, we don't really get too much visibility from my desk on how the earnings reactions go. Sometimes you'll see it feed through into sort of general index volatility that you see. I think maybe for the last 2 months, especially sort of the big names, sort of your Nvidias, we've seen them probably beat estimates, but they don't beat them as comfortably as they might have done in the past, and then you get this negative reaction from the market. I think it's probably an interesting point, but I would also probably say it depends on that name, and it depends which company we're actually talking about here. I think each of them, they're probably going to have different situations. So if you have an Nvidia and they might beat estimates, but they don't beat it as comfortably as before, you might get this off reaction from the market, even though it's generally good news. That's going to be interesting to see. Also, you mentioned natural gas then. I just wanted to add, we obviously collect a lot of data, and we'll see client sentiment. Natural gas for us has become quite a popular market over the last month or so.
Client sentiment up, yep.
Yeah, so there's quite a lot of interest there. Volatility on the option side has spiked up quite a lot, and it's very volatile in terms of that volatility. So you're getting a lot of moves in the market that are then translating into the options market. So we're seeing pricing shift around quite a bit there. We'll just have a little look actually to see. It's quite a strong upside sort sort of bias here, so a massive skew towards the upside move. But yeah, it's become quite an interesting market and become a lot more popular in terms of clients trading it on our side.
Yeah, and the client sentiment, just a reminder, all you trader friends, a gentle reminder, this is a glimpse of the sentiment on the IG universe. So it's just the IG universe, not, any sentiment from fund manager or anyone external. We do have other questions coming in. Wardy asking about gold, saying good results with NFP last Friday, which should have been good for the dollar, yet gold continued to rise. Does this mean the markets are still worried about Trump?
I think it's not a bad argument to make. Gold's a very interesting one. I think a lot of the regime and expectation of how gold moves throughout the entire of 2024 just hasn't really made too much sense. It had that ridiculous rally, which obviously seems to have come to an end now, but we keep coming down slightly and then returning to this regime of gold rally. And obviously there are sort of political uncertainty and these factors that might add into gold around the world, but it's quite an interesting one. I've not actually seen it this morning, but looking at the daily volatility on gold, it's definitely ticked up from excluding Friday from last week.
So what is the volatility telling us about gold? Is it rising alongside the other markets we mentioned earlier, or is it sort of calming down?
It's rising as well. I think we had a point in December, sort of towards the end of the month, where index volatility had spiked up massively since the Fed. Gold had probably stayed at a lower level, but we're now seeing it match to this higher point. Obviously, I'm looking at our weekly market volatility here, which is going to include your CPIs and growth figures through the week. So it's going to have a bit of a tick up through that, but it's definitely risen, probably around 4 or 5% since last week. So it's definitely back in the question for one of the movers.
Now, gold, just speaking for Wardy does, because he's watching us right now, just taking a look, if you whack up my chart on a more short-term view, you can see here that it looks like there's a consolidation up towards my second golden line there, towards 2716 per troy ounce, and it looks like if volume does not fall off, it will continue to march towards that figure. But as you can see here, there are two occasions where it's tried to punch through that line to get to my perforated golden line and not managed to get through. If it punches through meaningfully past that perforated line, then we could see a march up to the high since October. So that is a shorter term for you. Wardy does, I hope that is helpful from a technical viewpoint. But yes, I agree with you and Jack, it is acting out of kilter at the moment. Jack, also, I kind of felt a bit kind of with gold, and that's my kind of stand back and let's reassess the situation. When Jensen Huang made that prediction that quantum computing was going to still be way off, something like 3 decades, and you remember all the quantum computing stocks sank. I think they might have come back up now, but they sank. But this also took some of the shine off. Right, how much time we got, Gallery? Got a minute and just over. Jack, what other bits and bobs could be interesting for our trader friends this week?
This week, I mean, mainly we have the figures. That's probably what my desk is going to be most interested in through the week. I think we're going to obviously stress the importance of CPI, but there's also these growth figures. And I think, especially from how we saw cable reacting at the end of last week, I think that might be a market for some interest. The volatility today is quite high. That's for the 0DTE stuff, so expiring at 8 p.m. tonight UK time. The volatility that we're seeing on cable and also sterling yen, so many of the GBP crosses, it's been massively unstable since last week. We started to hear about the bond market in the UK. I think any negative impact that we see on growth figures, inflation figures in the UK, they're going to start to be very prominent, and I think they're going to have an impact today. So I'd say cable for this week, outside of CPI, is probably the market to watch.
Brilliant. Thanks very much, Jack. And we will be checking in with you ahead of that. Next up, opening bell.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Hey, welcome back to the show. And we have the one and only Aaron here.
How are you?
Good, very good indeed. How was your weekend?
Very nice, thank you.
Yeah, what did you get up to? No more cycling, I hope.
No, I ate Vietnamese food instead. That's
Nice.
much more relaxing and less dangerous.
Did you cook or did you go somewhere? Where did you go?
Oh, I just went to a local restaurant with some friends, so I can't cook Vietnamese food. No.
Would you rate it?
Yeah, it was good. It
What's
was
it
good.
called?
Vinam.
Vinam.
Yeah, it's just a local one.
V-A-I.
Vinam.
V-A-I-V-Y-N-A-M. Vietnamese. Images, food, restaurant. I've got people doing karate or something. Oh, right. Okay, here we are. Nice. It looks really, really fresh.
Yeah, it was pretty authentic. I've been to Vietnam before and it was a similar quality. I think it's probably the closest I've had to real Vietnamese food, so I was very impressed.
Oh, I'm getting really hungry now. Wow, okay, I will check this out. Speaking of checking stuff out, gilt markets, bananas.
Yes.
We've got loads of people asking questions, and we might have to stop there for the all sessions because we are about to get there. But we still have 50 seconds. What would you say to those going, when is this going to start looking calmer? Because it's been looking, red signals for such a long time.
Well, I think it's a broader policy and fiscal issue which is in place, which is probably caused by the budget. With the employer NI rise just shows that, I think that there's potential for there to be extended inflation because of that. Those costs increases are going to be passed on, which is why we're seeing sort of the gilt market throw a little bit of a tantrum. And it's an issue where it's very different to what we were seeing with the Truss mini budget, because that was too much too quickly. This is almost a lot of ingrained things which are happening over a period, which is why you're not seeing that spike, but you're seeing this sort of, I guess I could call it sort of a slide upwards in gilt yields.
Right, hold that thought, we've got all sessions up and away now. Virgin Galactic, one of the gainers there, up 0.2%. NEO, one of the stocks that have been beaten down quite a bit in the last few weeks, if not months, also up slightly. We are checking in on the down arrow stocks for you as well. MicroStrategy down almost 3%. Clean Spark as well on the losers list, along with ASML and Pinterest. Interestingly enough, Nvidia also down 2%. Any of those there catch your eye, Aaron?
Well, I think, given the jobs number on Friday, it's really interesting to see sort of those tech longer dated cash flow stocks, growth stocks selling off in this all sessions. I mean, obviously, what that means for investors, this higher job number coming in, I think it was around 100,000 jobs more was the official figure than expectations. It just shows that we're unlikely to get, these super rate cuts, which are going to supercharge equity markets. That's why we're seeing sort of a broader sell-off, and we're seeing also, 10-year treasuries, their highest for I think it's a couple of years as well.
And also seeing some of the names related to Bitcoin falling as well. Yet again, maybe some risk coming off.
Well, absolutely. I mean, Bitcoin is most certainly a risk on, probably the most risk on asset class in the field of markets at the moment. And absolutely, it's definitely a proxy for risk. And when investors can sense sort of blood on the streets to an extent, I mean, this isn't exactly a very significant sell-off relative to recent ones we've had over the past sort of 4 or 5 years. But obviously there is sort of downward volatility, and investors, don't tend to pile into an asset class such as cryptocurrencies when there's, concerns about interest rates, inflation, and a general risk-off sentiment.
Right, so back to gilts now, and that picture out there. Lots of trader friends asking when are we going to see, sterling perhaps get better, going back up? Do we have any idea? Is there any signal? Chris Beecham was here earlier going, not seeing any sort of chinks of light just yet, or at least they're not, not visible.
Yeah, I agree with Chris. I mean, I think it would take sort of a government statement or a change in government policy, because that's really what reversed the course of the mini budget, was sort of an abandonment of the policies, the sacking of the Chancellor, new Chancellor coming in who was much more, I guess you could say, fiscally prudent relative to what Kwasi Kwarteng was doing, where him and Truss were trying to do too much too quickly in terms of pro-growth agenda in an already inflationary environment. So I think it would take sort of either a change of policy from Rachel Reeves, some kind of, statement from the government, that sort of thing. But the concern is fiscal borrowing, concerns about fiscal debt in the UK, and the supply of gilts which come with increased deficits, for any government borrowing money, and this sort of concerns about longer, stickier inflation, and the policies, suggest concerns about that, particularly that, increased employer NI. It's likely many businesses, if they want to keep their profitability, will pass on those costs, and that's just going to be, higher prices for longer, just keeping, just being increased over time, which is a real concern, and which is why the gilt market is saying, hang on a second, we need longer term premium if there's, this sort of things,
Right, hold on to that thought. We're just going to get ready for a live from the trade desk, but just a reminder, trader friends out there, it's looking like a good start so far to the all sessions. Those stocks related to Bitcoin having a down day. However, some of those stocks as well to do with high growth may be taking a bit of a breather at the moment. But on the gainers list, Beyond Meat and Neo and Baidu as well. Right, so welcome back. This is live from Trade Desk with Aaron Bright from Smart Portfolios. We're just talking about gilts and where they're headed, where the pound is headed. Lots of our trader friends asking, you know, where's that chink of light? What's going to be hopefully the catalyst that boosts sterling? You know, some of those, you know, they're both sides of the fence. Some would say that, you know, Rachel Reeves needed to take action, right? Needed to come out with all those fiscal policies. But then those against what she's done have said that bad socialist choices are now coming home to roost. What are you seeing? What are you getting in terms of a messaging from the markets?
They don't like what's going on. I mean,
I know
yeah.
businesses, you know, business leaders definitely do not like.
No, obviously I can't talk too much politically on here, but obviously markets want to see policies which are pro-growth. They want to see policies which are, you know, good for businesses, lower tax, all those kind of things, less regulation. And obviously the policies we saw in the budget were, you know, difficult. And I was going to say Ed Miliband for a second, but it's Keir Starmer who's the Prime Minister. He said prior to the budget that it's going to be a tough budget, and it was relatively tough. So obviously businesses, people who want to grow businesses and grow all sorts of services throughout the UK will want something which is sort of more, I guess you could say, neoliberal. So yeah, there's definitely, and we're seeing the market throwing a little bit of a tantrum to that, especially the pound sterling relative to other currencies, and also the bond market more importantly.
Andrew McKilvey asking a really good question here and wants me to put to you, in terms of gilts, how much further will rates rise and what is likely to stop the trend?
I wish I could give him an exact figure. You know, yeah, then we'd sort of do it optimally for our portfolios. Look, I don't think we're out the woods necessarily yet with that. And as I said, it would need to take sort of a change in sentiment in the UK.
And you mentioned maybe a change of
yeah, potentially
policy.
Yeah, change of policy, change of government, or some kind of statement where there's, you know, with as I said, with the trust thing, it was a whole idea of we're changing, or we're doing things slower, or we're alternating the way. And yeah, that is something which would calm markets. But at the moment, as Chris Beecham said, there isn't this sort of catalyst for change. And I guess that's what the concern is. We've got growing fiscal debts in the UK, deficits, and policies which could lead to stickier inflation, particularly. And we've also already got kind of sticky core and services inflation, which is a concern as it is. Plus the policies which have come in haven't been the most inviting for investors.
What's interesting too is Rachel, I believe she went on this despite the controversy and, you know, calls for not to go to China. She did. Mm-hmm. But that wasn't the key thing for me. The key thing is that in a time when, you know, China is looking to branch out and create these bridges, whilst Trump is, you know, inauguration looming, you know, saber rattling already started. I believe she came back with just £600 million of investment, you know, something to that tune, which isn't very much at all in the grand scheme of things.
No, it's not. And
the whole point of the whole, you know, Brexit process was to kind of strike out and make all these deals, right? Mm-hmm. And we've seen them few and far between. This another reason why, you know, sterling and the UK economy under pressure. Just showing the chart here because, you know, we have a lot of cable traders here, and we are seeing it edging ever closer to that 120. Do you think we'll get there soon?
Yeah, I think if this continues, absolutely. I think there is, you know, if there's continued sell-off in the pound, then we could definitely see this sort of 120 mark if there isn't a change of rhetoric or policy.
Right. So Treasury yields also on the rise in the US, you know, with Trump incoming. The difference is they have a strong economy there, and they've got a strong consumer still. And jobs, my goodness me, looking at that number on Friday,
Very strong.
very, very resilient indeed.
I'd say it's almost an entirely different scenario. Yeah. It's like a different side. You've got the only thing in common is you've got rising bond yields, but apart from that, it's poles apart.
Yeah. And the only thing about the US economy, I think, is that it could potentially be, a victim of its own success, running hotter.
Yes, yes.
Right?
It's too much of a good thing.
Yeah.
Yeah.
And then it becomes a bad thing.
Yeah.
But I did also note that job vacancies were on the rise. And also there was data showing that companies are now struggling to hire new workers there. Do any of these things concern you, or do you think actually it's going so well that it's very hard for any of those sort of data points to derail the hot labour market there?
Well, yeah, I mean, any data point which is sort of prolonged and extended obviously is a concern. So if we're looking at, economic data and we're seeing vacancies fall and we start to see unemployment rise, yeah, obviously it's a concern for us. But at the moment, the data coming out of the US continues to be very strong, both in earnings and in employment figures. And obviously we saw that sort of jumbo non-farms payroll figure come out on Friday. And, even though we'd expect maybe the markets to react positively, they saw it as good news is bad news, because it means that the rate path has been slashed for where we see potential interest rates going. So the path downwards is now, more straight rather than a downward slope towards lower interest rates.
Yeah, sliding on a banana peel.
Yeah,
with oil underneath.
Sounds very slippery.
Yeah. Andrew, good point as well, because Andrew McKelvey was asking me Friday before we got to the weekend. I said I would check, which I then sparked off because he was asking me about Pearson. I said, I think I have Pearson in my pension portfolio, which I rejig around this time of the year. Andrew McKelvey, I did have Pearson, but I moved out of Pearson last year. But what I did see out of looking at all my pensions is that I'm about 70% in terms of weightage North America, i.e. US. Would you say this is overweight, too much, or do you think I should?
Well, if you compare it to the sort of ACWI, you're actually at weight. You're
at weight.
Yeah, you're at.
I'm the right weight. This
yeah,
is great.
US equities are about 65 to 70% of global market cap. So you're at the weight of
optimum weight.
Yeah, of the index, but that is obviously a very chunky weight for any position to be 70% in the US. So in our smart portfolios, we're not that high. We're around sort of 55% US equities of our equity exposure. But there is concerns with the US about how long can this exceptionalism continue for. Its GDP exceptionalism, its earnings exceptionalism, and its valuation exceptionalism. So there is definitely an argument for diversification across other areas, whether it be Europe, continental Europe, or the UK, emerging market Japan. So it's always good to be diversified, to get having a broadening out of your portfolio, whether that's in geography or market cap size.
In terms of sectors as well, we talk about this a lot. 2025, there are concerns that indices can't continue rallying like they have been. The NVIDIAs, we've seen those tech stocks come off.
Yeah.
Where is that smart money likely to flood to?
Yeah, it's a really interesting point. I definitely think we're likely to see, a little bit of a broadening out this year. We've seen consecutive years of 25% for the indices, the S&P 500. So we're likely to see sort of a more money move across sectors, potentially be more defensive. But I think a lot of that's going to depend on earnings figures we see, how they come out, if they continue to be strong, and what interest rate policy looks like. It's an exciting year ahead, and so far it's already got off to a pretty rocky start in the bond market.
This is the whacking up my chart for the US 500 richest 2025 expectation there for year end 4789. I haven't come up with my number yet because I just think doing anything before the 20th is a bit of a fool's errand. Also, one of the key things that we've been watching out for is what the 20th might bring. Those of us looking, even trader friends asking for a specific pension show once a month, which I like the idea of. I think it was Monkey Man's idea. You know, is it best to rejig before or after the 20th, or does it not matter?
Doesn't matter, I would say. Look, if you're investing in a pension, you're looking at sort of
long term,
10 plus years, right? So one day in the markets isn't unlikely to determine long-term returns. I mean, can't say that with certainty because no one knows what's going to happen in the markets. But look, if you're investing for the longer term and you're investing in a broad diversified portfolio, you just sort of ride out the volatility, which is in line with your risk.
Monkey Man asking, and should we be looking at space technology? Speaking of long term, this is very long term out there. I really like it, and what I've been looking at are companies that are not just involved in space technology, but they produce things that have a high use capability now as well as in space. So I'm looking at those specialist companies out there that make specialist composite materials that you need to do with space travel, and also glue. Glue is very sexy. So I like Henkel, that German company that makes glue. We already use them in things like smartphones. They glue car doors. You probably have Henkel in your life without even knowing it. There's also another space company that I've been looking at very closely with Luke Moore, and they make the only company out there that can make ball bearings and screw fittings strong enough and light enough for space travel.
Very important, very important, yeah.
So you can see that these materials are needed right now here on Earth, but they will definitely be needed.
Preparing us for our life on Mars, right?
Exactly. Yeah. I heard it's very cold there, and also you get squashed by intense gravity, so we'll have to live the first 3 years or many, many more setting up. I mean, I'll be hopefully long gone by then.
I've got enough of Earth to see so far.
I'm with Aaron again. And apparently I've been reading up on this. The first few iterations of humans on Mars will, or further out, who knows where, will be underground.
That sounds unpleasant.
I don't like the dark.
No.
I'm pretty much almost legally blind. I think legally blind. I've got very bad astigmatism, so bright lights isn't going to do.
Because there's no spiders on Mars, I'm fine.
You don't like spiders?
No.
Oh my goodness.
Yeah, now I'm probably going to find some in the studio or something.
You look so brave. I mean, I would not have thought about that. I mean, you've jumped off a cliff edge in Argentina.
Brazil, that was.
Brazil, sorry. And what is it a certain size spider or any spider?
Oh, any insects, really.
Oh my goodness me. There you go.
Yeah.
So yeah.
Now the world knows. I shouldn't have said that. Yeah. I could never go on I'm a Celebrity if I was famous. That would be the you know, where they do all the trials and stuff with insects. You know, I wouldn't do it for all the money in the world. So.
I don't mind spiders because they eat stuff that we don't like.
Snakes, rats, they're all fine. I don't mind any of that stuff. But you know, spiders or.
I don't like anything near my toes. So like the whole like
the fish thing,
Oh God, the fish thing, or like the tie. What would anyone pay for someone to touch your toes?
I went to a waterfall in Thailand where they actually have big fish in this area you can swim. It's called the Erawan Falls, and it almost gives you that massage thing for free when you're in there. So
because they eat the dry.
Yeah. So you're just in there and they're just nipping at your toes.
Say that again.
Erawan Falls.
Erawan.
Okay.
That's the fish.
Yeah. Oh, is it? Okay.
So they were they quite big?
Big, yeah.
So Erawan is a type of fish, kind of like the Thai version of the Araipem. Is that right? You know, the giant fish that you find in the Amazon.
Yeah.
With scales like steel. There you go. Monkey Man saying, very funny. Thank you very much about spiders. Are there spiders in Mars? I don't know.
I hope not. I really no.
Yeah, Aaron and I are not on that Mars thing, Monkey Man. But I'll find out the name of that company that makes the fittings. They literally are fittings, but the composite is so strong and so light that they're currently the only manufacturers of these screw fittings for spacecraft. And it's a good one to look out for because, you know, you can use it here and also as humanity tries to go beyond. Right, how much time we got, guys, in the gallery? So we've got 1 more minute to go. A really exciting day. Let's just have a look at the indices here because we are currently risk off at the moment. FTSE down 0.5%. German DAX down 0.75%. Let's try and drill down using my watch list here for you. Germany 40. Let's have a look at the gainers first. Porsche up 2.5%. RWE as well. Let's zoom that in for you. And Aon also up 1.3%. But on the losers list, Rheinmetall, a defense stock that Andrew McKelvey knows very well too. Infineon Technologies down 2.5%, chip maker there. Heidelberg Materials also down 1.7%. Let's have a check on some of the other players here in Germany. Aaron, any of these take your fancy, catch your eye?
Well, interesting to see some of the autos, performing quite well this morning. But yeah, no, interesting to see Germany's performance last year, very strong performance relative to the rest of Europe, and considering its economic woes. So a lot to look for, in continental Europe this year, given its economic problems, and we'll see how it fares in 2025.
How much of this is relative to the political problems? Has it in France? Has it benefited from that?
Yeah, potentially. I think so. That people see Germany as a relative darling, I guess.
Relative darling. Is this what you say to your other half? Relative darling. Speaking of the relative darling, here's the CAC 40, the France 40. Some of the movers, those moving higher, Rentokil, Engie, Bouygues, and Total Energies as well. We're also seeing Carrefour up almost 8%. Why is it when you go to a Carrefour on the continent, the food always looks a lot better than Carrefour?
I went to one in Argentina actually.
Oh,
yeah.
Was it good?
Yeah.
Carrefour in Asia, you don't really want to. Most people don't want to go in.
Goes to 7-Elevens. That's the popular ones in Thailand.
I love 7. Yeah.
You get the toasties as well.
And the toasties.
Yeah, they're epic. Yeah.
That's Japanese, isn't it?
7-Eleven.
Yeah,
oh,
isn't
really?
it? I think it's Japanese. Trader Friend, 7-Eleven. Is my memory serving me right? Japanese store. Gallery says no idea. Let's have a look at the losers. ST Microelectronics down almost 4%. Publicis down almost 2%. That's the advertising group. I believe they're strong suit there. Outdoor advertising. Safran, that's defense again. Any of those that catch your eye, Aaron?
Yeah, interesting to see Airbus down a little bit, down just around 1.5%. I think my eyesight is serving me well. And yeah, and also Dassault, another aircraft and defense manufacturer, also down similarly. But interesting to see how things are moving early this morning out of France.
Yeah. And also interesting that some of the luxury stocks as well are down. Given we had not so bad data out of China. But,
which is a huge, big buyer of this kind of thing.
Yeah. But we're seeing...
Huge luxury buyer, China. Yeah.
Hermes down 1.3%. Showing you Hermes now. And this one normally holds up better than others. But it is down at the moment. Let's have a look at...
what I admire about these luxury companies is just the portfolio of companies under them is just incredible. They have like the likes of Mont Blanc and all these sort of companies, and they're owned almost like subsidiaries of one of these listed companies. I mean, the portfolio of companies is incredible, really.
And it's very clever too that they've tried to plug every single
whether it's the luxury alcohol market, shoes,
skiing, Montclair, or whether it's to do with watches. So this is LVMH here. This is a monthly chart. As you can see here, struggled to get to the highs seen recently due to concerns that the consumption and demand from China is waning. On that note, we're going to have to wrap up. I know you've got a podcast later
We do,
on.
yes. Investing with Beecham and Bright.
Yes.
So yes, that's every Monday that comes onto the platform.
Nice. And just remind me again, I think if my memory serves me right, it's to do with why macro matters. Is that right?
Yes, that's today. So you can find that on Spotify, Apple, and YouTube.
Brilliant. There you go. Thank you very much. Look forward to watching the podcast.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Welcome back to Market Measure. So today is going to be helpful to anybody looking to start trading with a smaller account. So yes, if you are just at the stage of opening a Tasty account, haven't funded it yet, or you are just starting off, then here is a market measure from Sahil on how to put your best foot forward.
Nice.
So as we enter the new year, more traders start to enter the market. It's important to look at how to start trading with that smaller account. With markets trading at all-time highs, well, they were, it may be easy to overlook the scope of stock market growth over the last few years. In fact, over the last 5 years, S&P's almost doubled, the Nasdaq has more than doubled, and the Russell 2000's up 600 points. Now, as asset prices rise, new traders may find themselves more capital constrained than when they first start out, because the capital requirements to trade options increases proportionately to asset prices. Okay, i.e. 100 shares of Microsoft now is, well, not really, not Microsoft, Nvidia. 100 shares of Nvidia is a lot more than it was 12 months ago. Unless a stock split's bringing its price down, we need to find underlyings and strategies to trade that, to keep capital requirements low and percentage probability of profit high. So there is the different share prices that we can see over the last 5 years. The QQQ's Meta, almost trebling Meta. Wow. And it's been lower as well. It went 206 to 100 and then up to 620. Not quite trebling for Netflix, and McDonald's up 50%. Even McDonald's
Even
up 50%.
McDonald's. Wow.
That's those salads. Simply adding long wings may not be the answer. Even though we still have access to defined risk trades, be aware that a fixed width spread or iron condor in an underlying that increased significantly in price sees its probability of profit greatly reduced. So in order to get the same probability of profit that you had in 2019, your wings on your 20 delta iron condors would need to be $20 wide, making it much less feasible for smaller accounts because that would take your capital requirement higher. So yeah, 69% of the iron condor in deck on the IWM, and 61% that would be today, with long strikes just $5 away. So the answer to this dilemma is actually not as complex as it seems due to the beauty of product indifference, i.e. you can trade anything. And that's what the Tasty guys really like, Sosnoff included. That, in other words, as long as the product you find is liquid, there's a small spread between the bid and the ask. The name of the company doesn't matter too much when it comes to the risk reward of a trade. Now, that's a good point just to throw in. Ian Holmes has just emailed to say that knives in Greggs outlets are banned for health and safety reasons.
What? Why?
Just in case you stop you catching a falling knife in Greggs. Thanks for that. Added a little bit of humour to my dilemma at the moment of how to manage that position. But that's so product indifference. Assets below have a relatively high IV and IV rank. They are liquid and are reasonably priced. So iron condors or even strangles may be doable for traders with small accounts. The whole idea being that if your capital is low in the account, then you've got to find something where a lot of that capital is not going to be eaten up with that first margin requirement, let's say that initial BPR. So FXI, a price of $41 for a 20 delta strangle, that is $495. On the EWZ, the same thing, $278. On the gold it is 457, and on silver, 409. Now, small accounts tend to be capital constrained from doing undefined risk trades, which is why tasty bite traders often opt for defined risk trades. Angeline, how can we strategically choose undefined risk strategies like strangles and short puts and calls so they would be available to smaller accounts, maintaining the benefits of undefined risk trades? Spoiler alert, it has to do with implied vol.
Right. So I think you're going to say that Sahil's crunched all this, and he might say, try and focus on liquidity, i.e. liquid stocks. Is that right? Well, for both low and high IV underlyings, using a defined risk strategy will cost between 25 and 40% of the credit received, depending on the IV. This is why you hear the tasty guys talk about IV so much on IVR. So this is the chart, strangle versus iron condor, one standard deviation, iron condor versus one standard deviation strangle. And then you see the percentage more credit there. And you find that high IV got us back plus 34%, and low IV was plus 38%.
Right, when using undefined risk trades in low IV stocks, you get a sizable increase in BPR. However, in high IV stocks, the percentage increase in BPR is much less, allowing you to use more undefined risk. That's better credit to BPR ratios. Now you can see there that the one standard deviation condor goes 440 to 449 in a good old CMG, one of our favorites. In the one standard deviation strangle, from 599, 600 to 710, and that percentage change in BPR, 36% in Delta Airlines and 58% in CMG. Right, what are the takeaways, Ange?
So here are the key things to remember. Many popular assets have more than doubled in price over the last 5 years, boosting the difficulty for new traders with limited capital. Defined risk strategies cost 25 to 40% of the credit received. However, undefined risk in high IV stocks offers a better credit BPR ratio and smaller BPR increases, making undefined risk more feasible for smaller accounts. New traders should focus on product indifference, prioritizing high liquidity, moderate to high IV, high POP, this is probability of profit, and low capital requirements over specific asset names.
Wonderful. So we've actually both found that, haven't we? When we opened our Tasty accounts, first of all, I moved some of my money across, and the strategies that I was trying to do were taking up quite a lot of the percentage of that capital, and you
get to the point that at the bottom going, oh wow, and then you try and tweak your strategy, try and ensure that you have the right capital according to what you want to trade. And we've got a really good question from R. Sachs as well. What is the minimum, I think she's asking, for a small account for options?
To open the Tasty account in the first place. Well, you can open the account, of course. That's not a problem. That gets you past that first hurdle of doing the little test and things like that.
There is a test, but they give you 3 goes, don't they? As long as you're, I had to have 4 espressos at 3 p.m. to do that test. So as long as you're completely caffeined up, i.e. awake, you'll get it through RSX, no problem. You're very clever. You'll do it the first time round, no problem, right? They make you read through stuff, do the exam. Then it comes to, you were saying, Rich, with the funding?
Yes. So opening that account's the first thing. And then what we would be very happy for to have you in at some point, R6 Center, to do one of our workshops. So the workshops are what I'm going to launch at the end of this month, and then going to run them all through February, all through March. And we're going to sit down in the boardroom We're going to try and get into the IG
Take
boardroom.
over. We'll take over the boardroom. We've done it before. Shh.
And yeah, so we get about 8 to 10 people per session, and we'll literally just have a chat, work out what stocks people are interested in, and then show you how to make your first trade. And what we're really talking about here with that capital, yeah, how to, there's certain tactics that I've found are really useful. Like when you were trying to put a short strangle, turning that into the iron condor just brought that capital requirement right down.
Right down. Yeah. And also Rich shared a really cool trick that you found too, trying to get the order filled, but bring the price lower and trying to get it filled to your favor, so giving you positive skew. And Rich is right. You know, come in, tell us what you're interested in, because then that makes more sense because you're trading something you're interested in, right? How much time we got, guys, in the ready to wrap up? We've just got a few seconds. Okay, this one. Someone's had a birthday.
Oh, here we go.
Happy birthday to everyone.
Thank you very much. I am scared to open this.
We've only had, what is it?
Oh.
Someone has said, how long have you been with Rich? And I was like, we've been together, I guess 16 weeks now? Is it 16 weeks, 15 weeks?
Yeah, that's right.
It feels like forever. Thanks for being such a great...
So this is indicative of it's either going to be Lemsip or it's going to be cough medicine.
It is something that you voiced interest in. Lots of people were trying to guess what it was.
Oh, the slow gin. Thank you very much. That's brilliant.
And it is
from Scotland.
The 2024 vintage when Trade Live with IG was founded here.
Thank you very much.
Don't drink it all in one go.
Although it's the 2024 vintage,
small sip.
I'm still allowed to drink it. It's not like we're keeping it for 20 years.
You can keep it, but you're allowed to drink it. But don't go goo, yeah?
Yeah. Why are the directors shouting me to open it and have a swing now? Right, so yes, the answer to your question, R6 Senna, the option is margin, I believe. Yes, exactly. Otherwise, you have to have all your cash in there to cover the whole purchasing the stock if you want to trade stocks as well. So yes, that is correct. The margin account is the one you want to go for, and that's how you start to get those positions on. Now, talking about options and learning options, we have got coming up after the break, teaching Pega to trade. She'll be back in 3 minutes.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
That's right, and this segment has turned from teaching Pega to trade to teaching Pega options.
Yes, yes. Although before we begin, I heard that it was a special day this weekend.
We had, and I didn't actually finish off my story. I was telling Chris Beecham this morning, we went to Hamilton for the matinee on Saturday afternoon.
Yeah.
Then we went to a comedy club, and my girlfriend made us sit in the front row in the comedy club.
So did you get properly sort of heckled by the comedian?
And the final comedian was a female American.
Okay.
And she was very funny.
That's what they say about American women. That's the first thing that comes to mind.
She was from New York as well, so she was very direct. And then so that was in Leicester Square. So we popped into the casino on the way home. And my girlfriend refused to play anything in the casino because, of course, she's an economist. So she didn't believe in the upside likelihood that it's illogical to play any of these games because the house has the upper hand.
But
so that was a barrel of fun.
In craps, I understand that you have the closest margin, right, which is why there are so few craps tables. You need to have like the right balance, I think, of like a little bit of like woo-woo and also like a little bit of understanding of probability, and that's when like the magic happens in dice games.
Like you have some experience of casinos here, Pega.
The graduate school that I went to famously has a gambling history, so
wow.
Yes, I'm sure you can all watch movies about it on Netflix.
Yeah. Oh, fantastic. Good stuff. Right, let's dive in because otherwise we shall be short on time. First of all, this week, last week we looked at a covered call and also a cash-funded put.
Yes.
And so we're happy with that, that you if you own a stock, then you sell a call higher.
Yes.
And selling that call means you're happy to give away that stock if the price gets up to that level.
Yes.
On expiry. And the opposite in the put, as the share price comes down, then you're happy to buy the stock at that level. Good.
Yes.
So now we're going to introduce the graph of payoffs.
Okay.
Right, of calls and puts, because then we can start getting a bit funky with putting structures together.
Okay.
In the future, because everything just goes onto one of these graphs. And if you have let's take a look at it, first of all.
All right.
No, guys, sorry, you should have a slide there of the graphs. You jumped ahead. That's the crescendo. That's the final song in the musical. That we're going to come to that one at the end, because that is a options structure that I've just put on literally before I came in with Elliot Harris, and it's for Wednesday, and I think it's one of the best option structures I've ever done.
Cool.
But a long call spread. So this is when we are bullish, Pega. Right?
Okay.
Now, your profit and loss, yes, that is on the left-hand side.
Yeah, the y-axis.
The y-axis is the profit and loss.
Yep.
And on the x-axis, that's the price of the shares.
Okay.
Okay. So.
And that, the slope of the graph that we're looking at, that can change. That can be sort of more shallow or more vertical, just based on different dynamics, right?
Well, so I haven't put any numbers on this because I just want to keep it purely.
But that's the overall general, I guess, shape of the graph.
That's that.
Yeah,
Yeah,
okay.
that's the shape of the graph. So obviously on the left-hand side, right, where we're below the zero line, that is purely your premium paid.
Okay, yeah, so you're controlling that loss. So like if you've paid $2 or $5, you've agreed to sort of that little bit of loss to get that upside.
So the term that we're looking for is defined risk.
Defined risk, okay.
So that is, you know that before you put the option structure on.
Okay.
Right? Now this option structure also has a maximum profit level. And that's because it's not just buying a call.
Okay.
It's buying one call and selling one call higher up.
And that's similar to what we did at the very start when we did the spread bets with we did it with two different shares. So now we're going to use the same, like we'd have the same share, like Nike, for example, but we would sell in, so it would be the same share, but...
So the stock's at 71 now.
Okay.
So let's say we bought a March 75 call.
The March, okay, yes, that's only 2 months away. Gosh, it's closer than I realized. So yeah, so 2 months' time, we would buy a call for 75, which means that we have the right to buy it at 75.
But not the obligation.
Right, and then we would also have it, we would sell the call as well.
At what level? 80?
78?
Yeah.
Okay.
So if you bought a March 75 and you sold, well, let's do it, shall we? Let's have a look at Tasty and price that up for you, because that sounds like a kind of trade that I would like to put on.
Okay.
So yeah, if we get the Tasty platform up, we're looking at May expiry, and where Pega is talking about buying a 75, and she's talking about selling a, well, would you rather sell the 77.5 or the 80?
I think actually I would go for just that like little bit more in 80, because that means that that sort of plateau at the end of the graph that you just showed me was a little bit higher. So it means that I can make that little bit more money.
That's right. And then, so we can see here in the details at the bottom. Right, so we're buying a 75, one of them, and we're paying $2.38. We're selling an 80, right? So if you can imagine handing me $2.38.
Yes.
And you sell the 80, so I hand you $1.10 back. That's your change, right? So the mid price on those would be $1.21.
Okay.
So you're paying $1.21. Now that means that you've got $3.79 potential profit.
Okay.
And that's as high as we would go up that chart. So guys, do you mind popping the chart back on there, please?
And that calculates it for you. So it has the max. So that would be 379, that line across the top.
Exactly. And your maximum loss would be $1.21.
Okay.
So if you imagine that this is actually that the right-hand bit above should be double the size, well, triple the size of the bit below.
Yeah, so the amount you can make is actually much more than the amount that you are paying. And if I didn't want to make, £3, but I wanted to make like 37 pounds, then would I buy 10 of these?
If what, sorry, if you wanted to make?
If I wanted to make sort of 37 pounds instead of £3.70. Would I buy 10 of them?
Sorry, no, but the multiplier is 100.
Okay.
So buying one option contract is equal to 100 shares.
Oh, great. Okay, yeah. So it is actually.
I was thinking,
it wasn't
you're getting punchy.
It wasn't in pence. It's $300 then I can make. Oh wow.
Exactly.
Okay, fantastic.
Yeah. So 379 would be your max profit. 121 would be your max loss, and then I'm just trying to see. Was going to put that in. Let me see. Yeah. Okay. So that's Nike on the calls, right? Now let's look at the opposite way around, right? Let's look at that next chart and see if we're putting on a put spread.
Okay.
All right. So same theory, but sorry, the short call spread. I apologize. So this is. Has he put up the? I think he's put up the wrong one here. Short call spread. Well, okay. We can come off that. So if you are short a call spread, right? This is when we are. What I actually want to go to was the put spread, right? So if you're wanting to buy a put vertical or a put spread, that means in Nike this time, well, pick another stock. Delta Airlines was not your favorite, was it?
No. And it sort of continues to not be my favorite because of the sort of poor performance. But I think, yes, going into 2025, although I think, with a new president in order, I don't know that some of the normal headwinds on Delta are. So let's do it as an example,
right?
Rather than place the trade. Is that okay?
But this would be a good to buy a put spread rather than being short the stock, because then you've got that defined risk rather than unlimited risk.
Okay.
So let's just have a look at that chart to remind us what has happened to Delta Airlines in recent months. So yeah, we see it moving from 50 up to where it is now, 67. So it's come all the way up. In fact, it's almost doubled, which is quite remarkable. But yeah, trading at $67 at the moment. So let's look to put that put spread on in March. Currently trading at 67. What do you think, Pega, for what kind of levels?
Well, it's just gone up so much. So while I do think there are sort of, pardon the pun, tailwinds on the Delta airplane stock that are going on, I do think that it has just gone up so much. So there may be some, just corrections.
Mm-hmm.
So I think maybe I could see it going down to sort of low 60s. So between like 60 and 62.
Right. So let's look at buying, right? This is you're buying a put spread or a put vertical.
Yep.
Right. Now, a reminder that's you're buying the 65 put. So that's going to cost $3.40. And you're selling a $60 put. So that's costing $1.58. Sorry, that we receive $1.58. Now, put that all together on the wonderful Tasty platform, and we can see it at the bottom here. There's our details. There's your mid price, 164. That's what we try and get on at.
Okay.
And that gives us a max loss of $164.
Okay.
And a max profit of $336. So that's and if we go back to that graph now, please. Guys, can we go back to the second graph exactly? So that is, ignore the bit at the top, right? So that is long a put spread. Okay, so a long put spread.
Yeah, and so basically this is just the share price. So this is not time or anything. This is just the share price. So basically it's saying that as the share price goes down, so it goes to the left, that's what I need in order to make my sort of max profit.
Exactly.
But I guess I can make some profit that isn't the max profit as well. That's just the maximum that I can make.
And the way you, and sorry guys to jump around, but back to my screen now. The way you work that out is you look at what your spend is, and our spend is $1.64. The strike is $65. So you just do 65 minus $1.64, and that's your break even.
Okay.
And your break even is the bit on that chart when you hit 0. So therefore that is 63.36.
Okay.
So the stock needs to fall to 63.36 for you to break even. Everything else after that is profit.
Yeah. Okay. So there's an opportunity that whole left side of the graph, and so even if I don't make the max, I can still make a bit of money.
Yeah, $3.36 maximum, but you're right, anything up to that point.
Okay, great.
Now that takes us really quickly on to what I've just done for Wednesday's CPI. Wednesday's CPI, the one thing that can save the market this week is a low CPI, right? Now everybody's panicking about bond yields. Everybody's panicking about inflation coming back. So the one thing that will cause a huge relief in the market is a low CPI. So I was looking at a cheap way to put that on. So I went to Elliot Harris on the vol desk and said, Elliot, can you just work with me to try and get something here which looks nice? So let's chart up. That is buying the 58.80s, Pega. So you're buying a call at the 58.80 level on the S&P 500.
Okay, so that doesn't say, that's not the spider. It is the spider.
It is, yeah, it's the equivalent of the spider, but
Okay.
it's the futures.
Oh, I see.
So that's like 5,880. I'm buying £75 a point.
Okay.
Okay, and I've paid 12 for that. So 12.2. Now, I've sold 80 points higher. I've sold the 5,960s.
Okay.
Okay, so that's just like the Nike buying the 75, selling the 80s. I've bought the 5,880s and sold the 5,960s. But you can see I've sold the higher level in a bigger size.
Okay.
So now we're starting to do a ratio, it's called. So that's a call ratio. So I've bought £75 a point and I'm selling £200 a point.
Okay.
Okay, now that will change the graph, obviously, but what it does, it really cheapens it for me. It makes it a lot cheaper to actually put the trade on in the first place.
Okay.
Then finally, I have also said, okay, if it goes down to 5,580, if the S&P drops another 200 points, then I'm prepared to buy it there and £50 a point, and I sold that for 3 ticks. Putting all that together, right, for 80 points of upside, if we come in a low CPI environment, I've paid about 3.5 points.
Okay.
So the upside 76 points.
Wow, 76 points on 3.
I paid 3.5, yeah.
Wow. Okay. So that's when you're really making your money work harder for you. And you are really limiting your risk as well because you're only paying the...
No, that is quite a risky because that's undefined risk, which we'll move on to next week.
Okay.
Right.
Because, and is it undefined risk because you're buying it at that, at the 55.80? What's it?
Undefined risk because I would have to buy it at 55.80, but also if it goes up higher, then your profit, you saw how your profit goes up like this, it would start to come down again.
Oh.
So that profit line goes along flat and then it goes down.
Okay. Well, I look forward to learning more about that next week. I feel like
well, hopefully we'll have got a low CPI and it'll have expired exactly at the 5,960 level and we'll go out for lunch.
Sounds great. I look forward to it.
Good stuff. Right, we're on to, sorry, I've run over. Axel is waiting impatiently with his trade of the week about to come. I'll see you tomorrow. Stick around for Axel Rudolph. Thank you, Pegah.
Thank you.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Hello and welcome to this week's Trade of the Week on Monday, the 13th of January 2025. Last week we went long the Tesla share price, and we did so because we saw an ABC corrective move. And I might not have mentioned that that only works half of the time, but we like to put these trades on because basically when you get it right, you have a far greater profit potential than when you get it wrong. You have a relatively small loss. So let's just look at that chart, and you can see here the daily financial bet of Tesla, and you can see that ABC correction, this zigzag correction to the downside, and we went long just above here at around $417. But our upside target was around 500, and so far, unfortunately, as you can see, we did go up slightly on the next day, but since then we've come down. We haven't been stopped out. Our stop loss is below the 2nd of January low, just down here, because that's the end of this ABC correction, if it is indeed one. So that stop loss is still in place at 373.10. So nothing else to say on this trade. It is still in play. Now, this week, what I would like to do is to go on to another chart. Let me just go up and look at crude oil. Everything's gone up with regards to crude oil. As you can see here, we've had a very nice rally to the upside since December. And at the moment, we're still bullish. But I feel that we might be heading into a resistance area here. You can see we've got the highs going back to November, December of last year, and they might cap the upside in the short term. So because if I move from a daily chart to a weekly chart, because the trend, as you can see here, from last year is still pointing down, even though we've broken through this downtrend line, we haven't yet taken out the high from December. So this high, let me just go back onto the daily chart. This high comes in at around $78, and we are trading quite close to there now at the moment. And I believe that that high combined with the previous highs here and also the lows going back to earlier last year is probably going to react as a resistance area, and we might see a retest of this breach downtrend line before we move to the upside. And that's why I want to go short the WTI oil price here on this daily financial bet. So today's trade of the week is to go short WTI crude oil at around $77 with a stop loss above $79.10 and a downside target between $73 and $74.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Hello and welcome back to Technically Speaking. We'll be talking about some educational things first of all, and then we'll look at the trade of the week in a bit more detail and also at other charts. And I'm happy to look at your charts as well. So please send in your questions and I can then hopefully answer a few of those. Let's begin though with a basic first bit about fundamental analysis. And I would like the gallery for this to still keep me in vision. So we'll just do this one again. So what is technical, not what is technical analysis? What is fundamental analysis? And basically what fundamental analysis is all about, it's about value. And what it does, and I just quote here, is it's a process of evaluation determining the intrinsic value, that is to say the real worth of an asset by examining related economic, financial, and other qualitative and quantitative factors. So that's the definition. You can read it up on Google, etc. But what is it really? It's all about value. So what is value? Basically, what a fundamental analyst does is that he or she will study the underlying value of an asset. Could be a company, for example. And a share of that company can be overvalued, it can be undervalued, or it can be at fair value. And that's basically what the analysts do when they look at a share, for example. What they do is they try to determine whether it's a buy, so they give it a buy rating, a hold, or a sell rating. And or variations thereof. But basically that's what analysts do, and those are fundamental ratings on, for example, a share of a company. And when these analysts analyze the company, what they look at is macroeconomic factors, obviously, which are influencing the company's share price, because a company could, for example, make more profits in an economic environment where there are more purchases of their goods taking place and things like that. So they will look at macroeconomic things like GDP, inflation, growth, fiscal and monetary policy, and things like that. But they also look at company-specific things such as, is the company growing? What are its profit margins? What are its debt levels? What does cash flow look like? EPS, earnings per share, the dividend yield of the company, and things like that. And then based on that, they try to assert where the future value of the company will be, and they then make their recommendation based on that. A very successful fundamental analyst is Warren Buffett. You might have heard of him, who is a value investor. So what he and his fund, Berkshire Hathaway, basically do is that they look at undervalued companies, which in the future, in a few years' time, will then hopefully make them a lot of money, because they bought the share price at a lower level and they found value in the company which other investors didn't find. Now, that's all very well. If you want to do a fundamental analysis, for example, on shares, you can do that by analyzing a company. And we have these ratings on the IG website. You can look at that as well. But if you want to do it yourself, for example, on bond markets, what you would have to look at is interest rates, yields, the issuance of a bond. Is it the government? Is it a corporate bond? Ratings of that bond, things like that. If you wanted to do fundamental analysis on FX pairs, so foreign exchange market, you would look at interest rate differentials between different countries. You would look at things such as, for example, also purchasing power parity, and basically base your decisions on the big economic flows within these countries, whether one country is likely to outperform the other with regards to its interest rates and therefore also its currency, because a higher interest rate usually means that the currency that is linked to that is appreciating. You can also do fundamental analysis on things like companies, as I said earlier on, and share prices. The problem with fundamental analysis, in my view, is that it can get very complex and very complicated, and also you're looking at past data, which then quite often is revised. So you're looking at a lot of different variables, and these variables obviously give you all kinds of different outputs, and to then create a model which correctly forecasts what the future economy will do is quite complicated. And that's why I prefer technical analysis, where you just look at one variable and that's the price. And we'll talk about that next week. So after this long preamble, let's look at our trade of the week. And basically we can see here the oil price, and we're trading against the trend. So why are we doing that? Well, quite often markets move in trends, and you can see here we've been trading sideways for a long time with regards to the oil price, and now we're heading higher, and we've broken through a long-term downtrend. So if you go onto the weekly chart, you can see here we drew a downtrend line from our highest point from March 2022 through then the next higher point, which was the June 2022 high. But that trend line here would have gone through these data points in the future. So what we've done, we've redrawn our trend line now so that no data points go through there except for the break that we're seeing at the moment. So what I'm saying is we take the highest point here and then drew our trend line through the July highs, which incidentally acted as resistance in October. And now on this weekly chart, last week we broke above the trend line and we closed above it. So that could indicate that we are forming a bullish reversal here, and that the oil price might go back towards $90 per barrel or so. But it's not just the trend line break which is important. What is also important is to break above the last relative high. As we all know, a relative high is for example, on this candlestick chart, a high which is higher than on its left and on its right. Now, since this is a weekly chart, the 7th of October high, that's the relative high, because the week before we had a lower high and the week after we had a lower high. So we would need to also break above this last relative high on a weekly chart closing basis, on a Friday basis, for us to confirm this bottoming formation. In which case we could then be heading back up again towards the April high of last year, around $87 or so. Now, why am I going short? Because as you can see here, we've got the October high coming in slightly above current levels. We've got the high from the end of August coming in at slightly higher levels. We've got the low of May, which we've just flirted with at the moment. And then we've got the high going back to August of 2024. So we've got quite a lot of areas where potentially this uptrend might short-term stall. Plus, as you can see here, we're currently testing the August 23 low, which acts as resistance. And we've got this whole resistance area here going back between January of, actually November of 2022 and also the highs in April 2023. So that is a lot of resistance potentially. That is not enough to go short against the trend, because we normally like to trade in the direction of the trend. But what I'm also seeing is, can you see the high we made on Friday and also today? Basically, if you look down here at our relative strength index, the RSI, you can see here that we're making a lower high on the RSI compared to the previous high. So this is lower than that one. Yet the market, the oil price, has made a higher high. This high is higher than this one here. So when you have that, this is called negative divergence, because the market makes a new high, yet the oscillator makes a lower high. And when that happens, you've got a pretty high probability of, at least in the short term, over the next day or two or so, to see some sort of loss of upside momentum and perhaps also a reversal short term in the trend. And for that reason, and the previous resistance area I told you about, I believe that there is a pretty high probability that we might, at least in the short term, give back some of these recent gains and perhaps come back down again slightly. Now, how far can we go? Well, what we do, we look to the left of our chart and we look at the lower levels, below the levels we're trading at the moment. Where do we find support? Well, we find this high here from the 10th of October at 75.70. That could be potential support, but it's just one level. If we go further down, can you see here, we've got the high from September of 2024, we've got the high from October of 2024, and we've got the high from November of 2024, and we've got the low from early January, all of which comes in around the $72.50, $73 mark. So that is potentially really, really good support. But it might not go all the way down there, because now we've broken through our long-term downtrend. So maybe sometimes what happens is the market comes back, retests the trend line, the broken trend line, and then advances again. So I'm still medium-term bullish, because the trend from the December low is bullish, but short-term I think we may give back some of our recent gains and perhaps retest either this 74 area where our broken trend line comes in, or the 73 area down here where all the previous highs and lows come in. So this is how you build up a trade, and this is what we're looking at. And what we try to do is make sure that if we are wrong, we lose relatively little money. So for trade of the week, we risk 2% of capital, as you probably know already. And our stop loss is above these previous highs. So we put our stop loss at 79.10, and we are short from current levels. And hopefully, for our trade at least, the oil price is coming back down again. So this is how we build up a trade. And I hope I've explained how I look at markets and what I look out for. And please send me some questions. I've just looked at them here on my screen. I hope the gallery can send me some questions through. And until I get those, let me just see whether I've got those or not. I haven't yet. Okay, if you have any questions, if you want me to talk about your charts and analyze those, please send them through to us, and we will have a look at them and answer your questions. Since I haven't got one at the moment, let's just look at other markets which are really, really interesting at the moment, and that is the NASDAQ 100, because you can see here the NASDAQ 100 is basically trading through key support here. You can see we fell through the low we saw earlier earlier last week, earlier in the month, and we are now, it looks as if we're now heading down towards these lows here. And we can see that, let me just try and move my chart up again, that we're heading back down to this previous low. We're testing that on these previous highs. So potentially we may hold around the 20,500 area here. As you can see, we've got these previous highs and this low coming together. But we'll have to see whether we can hold there or not, and very much will depend on the inflation number, the CPI number, which comes out later this week. But look at the NASDAQ 100. This looks really, really interesting at the moment. Another interesting market to look at is the US dollar index, or the US dollar basket. As you can see here, we are on track currently for our 6th straight day of gains. And if I go from my weekly chart here, and zoom out, you can see that the next upside target is this relative high here. That takes us back to around 110. So that looks pretty likely. And what is the inverse of the euro strengthening? Well, the US dollar strengthening, obviously, it's the euro falling. And as you can see here, the euro continues to slide on the daily chart and is heading towards parity. So really downside to be seen in the euro. in the British pound against the US dollar. As you can see here, we're very quickly approaching our low from last year, and you can see that that was made down here around the 102 area. So we've got these round numbers, parity, 102, all of these attract these currency pairs at the moment. I've got a question now. Monkey Man asked me a question. Thank you very much. And the question is, which is more important? What should you take more notice of, the trend line break or the support levels? That's a very good question. And basically, what it is that a trend line break in itself, if you close through the trend line and close above it, so if you look at the daily chart, for example, and you have a trend line break above, or you have let's say you have an uptrend, you have a trend line break through the trend line to the downside, and you close below it, that's the first indication the trend could change. But most of the time what happens is you've got your trend, which is pointing up, and then it just becomes flatter as the momentum of the uptrend weakens. So that happens very often, which is why you also need to look not just at the trend line break, but more importantly at the last relative, in this case, the last relative low. If you fall through there, then it's more likely that you see a trend reversal. So I would look at the support and resistance levels, the important ones, which are, in my opinion, more important than the trend line break. And also be very careful if there's a trend line break just intraday. It doesn't mean anything. And a lot of people try to trade the trend line break. And yes, sometimes it looks great, but quite often they will just go through the trend line and then come back towards, and you have to redraw your trend line and flatten it a bit. So let's look at another question I've got here from another person, which is the S&P 500. Let me just put this up here. That's the last one we're going to look at now. The S&P, what does the S&P look like? And you can see here the S&P is similar to the Nasdaq in that it's currently, I mean, the market's not open yet officially in the US, but it's fallen through the previous relative low. That is bearish short term and may well mean that we're heading back down again towards these lows here at around 5,700. Now, it may hold though, because we've got this support level down here and these highs here. But we'll have to see what happens today, whether we can, on the daily chart closing basis, hold above this area here and bounce back. But right now, it looks as if we're breaking through this support and we may be heading back down again towards the 5,700 area. And you can see that this whole area here acted at really, really strong support, and it also coincides with this 5,650 area, these previous highs here. So that's a really important technical support area, and we may be heading back down again towards that. Very much will depend on the inflation data out later on this week. And thank you very much for watching Technically Speaking with me today.
FOMC Minutes show the Fed's worried about Trump tariffs. Markets don't seem to care. It's Wednesday, January 8th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan, also in New York, but not here. He's being honored for some CNBC thing, what have you. But best of luck to him and congrats on Overtime Fast Money all those years ago. Not Overtime, that's our show. Fast Money all those years ago for him. If you're following us on the platform, come over to YouTube. Tell us what you're trading today. Tell us what you think of this action and how you plan on approaching the markets the next 2 days with a partial closure tomorrow. Likewise, if you're already on YouTube, come over to the platform. Come over to tastylive.com. See what we're all about. Ilya, today was a fairly quiet day as the dust settles. The S&P is up by 0.12% after what was a day where we spent the day mostly lower. The Nasdaq ekes out a small gain. The Dow Jones ekes out a small gain. The Russell, which is the worst performing index year to date, is still lower. What do you make of today's price action, knowing that tomorrow cash equity markets are closed and equity index futures close at 9:30 Eastern?
Seems like the market got a little bit of a spook going into the minutes after yesterday's warm ISM data, essentially on the idea that maybe something here would be a more hawkish lead, and so we were lower to kind of kick things off. And then when the minutes came out, equities sort of begrudgingly returned near the highs of the day, but ultimately didn't go very far because nothing about these minutes really changed the game in any kind of a meaningful way. You just mentioned all participants, and I'm quoting now from the minutes. All participants judged that uncertainty about changes in policies affecting foreign trade and immigration was elevated. But at the same time, many of them said that there was reports of greater economic optimism stemming from easing regulations and changes in tax policy. So the political element here seems to have been something close to a wash. There was concerns about the one side. There was optimism about the other side. Probably for me, the key takeaway was that most participants, and again, I'm quoting, judged that with the stance of monetary policy now significantly less restrictive, that is to say, they've been cutting, the committee could take a careful approach in considering adjustments. In other words, they are going to slow walk things from here. And the fine balance, quote unquote, that they see in the risks to their mandate suggests that they're not going to jump aggressively one way or another. This is interesting, of course, because on the one hand, it suggests that the recent cooling in U.S. economic data relative to forecasts is not going to be something that the Fed reacts to seeing unless it persists and the data starts to get worrying in earnest, but also suggests that they're not going to jump out the window about the ISM numbers, and in particular the price component there, which was red hot, hottest since February of 2023, that they're not in a mood to be reactive. And so that's an interesting sort of takeaway, because for bonds, that meant a very narrow rise at the long end. And narrow is probably the operative word. I think the key is more so the intraday price action than really anything like a progression in a direction. If you look at ZB in particular, I think you can see it with sort of the most clarity here. So you had a day where you were much lower than you ultimately ended up, and you ended up there sort of in the wake of the minutes. So maybe the market has concluded that whatever hawkish rethinking they had to bake into this since mid-September is now done, but it is way too early to say all that until there is a more substantive bottoming that occurs. So I think the market basically looked at the minute and said, okay, right, moving on.
You mentioned the ZB here. There was a 30-year auction today. It stopped out at a high yield of 4.913%, which was basically 4 basis points higher than last month's 4.35. But it was the highest yield that a 30-year auction has fetched since August 2007. But at those rates, there was demand there, right? The auction did stop through. So in this very early part of the year, we're looking at probably the best auction we've seen in 2025. Is it enough for a turnaround? You know, contextually, if the market's pricing in higher inflation right now, and that's still an ongoing risk, then perhaps not, right? That's something we need to contend with. One thing that we can't ignore, though, is that this uptick in Treasury yields the last few days has been buttressed by a move higher in oil. Oil and bonds tend to have a fairly significant correlation. They trade together. So when oil goes up, bond yields go up. Today is an interesting set of action in oil, though. It's not quite the bearish outset engulfing bar one might want to see to mark a top. We didn't close below yesterday's low at $73.11 per barrel, but we do pierce yesterday's high and we get pretty darn close to it. And
the spirit of it is there.
it's you can squint and you see it, but we run into 75 again, which is an area that we ran into in late July. We do it again in October, and we're turning there now. For those that are inclined, we could see that the July and October swing high downtrend that's breaking, and that 1 week moving average today, we don't break quite below it. We're 4 cents away, but the contours of a potential short-term top are coming together. Are you looking at oil at all as a potential cue for when there may be a tradable low in the bond market, at least for a short-term swing?
I think it could be helpful. I think the bond market right now really is seeming to jump from catalyst to catalyst. So things were very, very quiet until ISM this week. We were kind of stuck in a range that looked like it was maybe starting to see the winds of momentum change. So if we look basically where we were from let's call it the days right before Christmas holidays all the way through until the ISM numbers this week, ZN basically did nothing and just oscillated in a very narrow range. You got a very unexpectedly hot ISM number this week, and they made a move. There was, I think, the expectation that maybe the minutes would be more hawkish, and that's how you had equities lower into the minutes overnight. You had bonds lower and yields higher into the minutes overnight. You had the U.S. dollar stronger than it ultimately closes overnight. Very little changed against the euro, the sort of benchmark cross. A little bit stronger against the pound, but definitely off the highs. So you have a situation, I think, overall where the markets thought the minutes were going to follow ISM, and then they didn't, and basically didn't move the needle. Could oil be the thing that moves the needle next? Sure. Because I think, as with Fed officials, the markets themselves are looking at this and going, well, we don't really know what the right next step is. It's a fine balance. And it's catalyst by catalyst, headline by headline. If you got a real meaningful sell-off in oil here, if this resistance ultimately holds around 76, 77, if that ultimately holds up, then you are probably going to get a little bit more of a disinflationary kind of vibe that the markets will pick up on, but at least in the near term, right? Markets are mainly closed tomorrow. There's some futures products, as we were just saying with Tom and Tony on last call.
Cryptocurrency, energy, metals, a handful of things, but equity futures, equity options, those are out early.
Right, and of course, spot markets will move. So spot gold as an indication of where the futures might head, where something like GLD might head, spot currencies, they'll continue to sort of show us at least where sentiment is. But we really don't have much moving or much doing here for the main markets until Friday. And there we have that jobs report that's a focal point. So are we going to get a crude oil inspired move that really moves the needle before that? Probably not. The market, even if it ultimately takes a cue from crude and extrapolates it to rates, to currencies, to policy expectations, it'll probably wait for that jobs data at least near term. So we're probably talking about next week for anything like that. And your sound is gone.
About that, all this sneezing here, how to mute the mic. I've seen some people ask, and I've seen the conversation on Twitter, I want to get short crude, but where's the volatility? I can't really sell calls right now.
Right.
Selling calls in crude when volatility is already really, really low, to me, is a very difficult thing to wrap my head around, simply because if you find yourself all of a sudden in the throes of a geopolitical event, price tends to spike, and then vol will spike from that low level, and you kind of get double tapped being short the calls. So in environments like this where you have a 15.7 IVR, if I wanted to take a short delta perspective, I'm not going to do it through selling calls or a call spread right now. I'd much prefer to do it with being long and at the money put, or if I'm feeling a little bit more confident and this being a turn, maybe something that's slightly out of the money, not too deep out of the money, but maybe like long the 71, short the 69 put spread, which just pulling up here on the trade screen, actually long the 70, short the 68, that gives you a 32% probability of profit, risking about 1 to make 3, just under there, which is a fairly good set of odds. And if you think this is going to be the top and you return back to the consolidative state where we were, it could work out. Or you could just simply be short the futures, depending upon, your account size. For most people, that means short MCL. But directionally, if you want to be short crude, doing it through the options is probably not the best bet, just given where things stand today. Now, if this was like where we were in October and we had risen up to 73, what were you and Radigan doing at that time? You guys were selling the calls. You guys were taking that bearish perspective because the volatility, the IVRs were up in the 90s. And it made sense there by that context, right? A geopolitical driven spike in the price, and therefore the volatility is there to fade. There's no volatility to fade right now. That leaves you potentially exposed to something, which is also to say that Iran was putting out cryptic warnings yesterday after hours that they'd be attacking Israel. Israel went on to high defense stance. Nothing materialized today. Ilya, we'll see what comes of that. But I'm waiting perhaps for just a little bit more here in crude to get short, to take that perspective. We haven't seen a close below the 1 week moving average thus far this year. Today, we couldn't do it. Tomorrow, if we start to slip a little bit more below there, I will put on that put spread. And if that way, my risk is defined in the event that I'm wrong about this being the potential near-term top. I'd rather do that than looking to sell a call spread right now, knowing that Iran may do something in the short term.
Yeah, and I mean, you could also, if you wanted to manage size, look at USO. That's a very liquid ETF. And if you wanted to say, okay, you know what, I'm going to take it from around here down to like 75, 74 and change, something like that, the top of the preceding congestion. I mean, that's a thing that's doable. But if you did it in this environment, you'd be buying a put spread, let's say, and you could get okay sort of parameters here, but the risk reward is really not that great. I mean, 77 to 72, something like that as a put vertical. But in any case, you wouldn't be able to do that here because, of course, equity markets are closed tomorrow, so you'd have to wait for Friday anyway. And with that, there's just nothing to do. It seems like whatever happens next is a U.S. jobs data kind of a thing, unless something happens overnight, like an Iranian attack, like something from the sort of Chinese story, something from Europe, something in the Russia-Ukraine theater. I mean, obviously, there's no shortage of possible event risks outside of the U.S., but I think the main story for markets still is rates, the Fed, the cost of money, and that story is not going to get its next headline until Friday.
Switching over from oil and staying within energy here, I put on a new long delta position in NGH5 today. We see that there has been more or less a line in the sand right around $2.85 in natural gas the past 6 months or so, when we were above it in August. September was support, and then more recently pivot points throughout December. And so right now, taking a look at this 48 days out, 275, 290 short put spread here. I also likewise see that we're beginning to break the downtrend in the NGH5 contract from the November 2023, June 24, and we'll call it November 24 lows. This is a lot of volatility up here right now. We're obviously churning as we attempt this breakout. But as long as we hold this floor of 285, I feel pretty good having that exposure right now. The only question is if I want to upgrade that exposure to a little bit more convexity by looking towards the 3.60 out of the money calls, and I'm very tempted to turn this into kind of like a double bull spread. Short the put spread on one end, long the out of money call spread on the other. Natural gas feels like it's a little bit removed from all the other events that are happening right now. And on Futures Power Hour today, we shared a chart thanks to Westwater, who unfortunately couldn't join us this afternoon on overtime. We were looking at the drawdowns of natural gas out of salt caverns here in the United States. And to start the year 2025, we're drawing down our most readily accessible natural gas inventories at a quicker pace than we have at any point over the past 5 years. So this could be an environment that is supportive for natural gas. We're feeling the cold here, at least in the Northeast today. The high for where I am in New York was a brisk 26 degrees Fahrenheit. So looking forward to putting on a fire shortly after we're out of work today. But let me promise you, I'm not trading natural gas on the long side because it's cold in my home. That would be ridiculous. That's not quite the level of shorting or getting long copper because someone on Reddit is short, but it's close to that brain.
It's not that cool.
That's pretty big twit territory. Anyway, I like the pricing here. Volatility is creeping up at a 61.6 IVR. And given the fact that I really just don't like a lot of the equity market stuff that's still lingering around, I have some light legacy exposure in here that's going to, whatever. I have no compelling reason to put on a new position right now in either ES or NQ. It's just primarily philosophically, I'm a momentum guy, right? The last few years, it's been really easy for me to be a bull because the markets are going up. But initiating a new position when you're in a symmetrical triangle or head and shoulders pattern that's potentially rolling over, you don't really have an edge. So I'd rather wait for some resolution here, get the NASDAQ retaking its uptrend and look for a play to all-time highs, or clear out 21K and give us a reason to go back down towards the lows that we had in early November. It's a lot of churn until then. And then with this market closure tomorrow and non-farm payrolls on Friday, just not really compelled to put some chips on the table just yet. It's not directional enough for me right now.
I agree. I mean, I have obviously the exposure that I have. So I'm short the S&P, but I've been short for a while. I've had that exposure for a few weeks now. I think I started laying on almost 2 weeks ago, maybe even a little bit more, 3 weeks ago. And of course, I've been short the Russell for even longer. I got a little bit short NASDAQ this week. It's working a little, but that's more just a retest of that former resistance or former support become resistance. I was looking for a rejection there. I got it, but it hasn't really made ongoing progress at this point. It's only really just gotten to the lower half of its range, which is what I was looking for. And now I'm just waiting, sort of similar to what you've just described. There's not really anything that's screaming here. I thought we might get more action out of the currencies so far this week, but that really hasn't materialized either. The British pound, we were saying earlier, was particularly strong today, and the move seemed to appear around like 11 GMT. There really wasn't anything there on the docket that day that time that seemed to do much of anything. So it doesn't really look like what's going on here was sort of motivated by XYZ headline. It just looks like the pound had a particularly strong day. What's interesting is that it ultimately, if you look at the daily chart, it ultimately doesn't manage to take out the preceding swing low. And that's interesting here. It just barely holds. And what's sort of the interesting context for that is if you look at your momentum indicators, they're actually showing you positive divergence. This is the kind of thing that might happen or that you could expect to see when a bottom is getting carved out. So you set a nominally lower low, but ultimately you don't close under the preceding bottom. So it's sort of a gut check on a turn. that ultimately fails, and then you find a bottom somewhere basically here. I don't think you have confirmation. I actually got a little bit long earlier this week on what looked like a bullish morning star that formed basically at the low that has now held. But so I'm a little bit long here and hasn't worked yet, but it didn't shake me out today. This is starting to look a bit interesting. If there is confirmation and we start to anchor right around here, this could be a compelling long. Similarly, the Canadian dollar did some interesting gyrating over the past several days. It could be setting up a compelling long as well. If you look at the internals of 6C and you take a look at it on, let's say, like a 4-hour chart, it looks like you're in a range, in a choppy, ugly range.
If we go any further, just the volatility here, by the way, utterly through the roof right now, 101.8.
Yes.
And the Canadian dollar, for all of its warts, trying to sell puts in this environment, I think this is just worth noting. We've had elevated vol in the Canadian dollar where the high end of the IVR has been mostly above 80 for the better part of the last 3 months. This thing has not been able to post a close back above its 1 month moving average through the entirety of that time. And we just had another touch of it 2 days ago. So, as far as I'm concerned right now, yes, I can see a lot of people out there saying, oh, I really want to sell puts in this thing. But this has been a falling knife environment for going on month number 4 now.
Yeah, no, I'm not looking to sell vol here. I've just outright bought the micro future. And the logic, basically, if you look at a 4-hour chart, say, you can kind of see it. The big green candle that we see on a daily chart doesn't mark a break, but when we look at a more granular timeline, we can see we've attempted a breakout out of the congestion range that developed there from about mid-December. And so it seems like an interesting thing to consider, especially since if you look at the last several candles here today, they hold at what is essentially the last line of former resistance become support defense. So you'd need it to hold right about here and rally, but so far so good narrowly. So I'm a little bit long this. I think there's a bit of room. So that's about it. I'm looking at, and this is how desperate we are for news flow. I'm looking at the ADP report today coming in a little bit light. I look at the employment components of the ISMs, which the headline ISMs were very strong, especially, of course, in services, but the employment components were soggy. And that's an interesting setting of the stage for the jobs report on Friday. If we get a sense that maybe the Fed doesn't need to get so hawked up on its positioning that we've basically seen the lows in bonds, then the dollar is going to probably take a leg lower. And so that's my exposure to that idea here.
You're looking through the ADP report?
See? Desperation. There's nothing going on.
Never. What did Robert Downey
Never
Jr.
ever
say?
look to the ADP report, by the way, is a great rule to have.
Yeah, it was in Tropic Thunder. He said, never go full macro. Never
right.
go full macro.
Yeah, that's right.
I think that was a line from Tropic Thunder. I can't remember.
Yeah.
No.
There's no news. What are you going to do?
Yeah, I mean, listen, it was one of those days. I mean, the pound is really interesting because I see that a bunch of, overnight, some of the people that I follow in the UK, there were some new electricity pass-throughs published because their rates are variable over there, and the recent reset of UK electricity rates for the next 2 weeks are like 4 times what they were for the prior 2-week period. Right. And so it sets up this, I don't want to call it like Liz Truss lettuce moment, but I have been, so I will continue to do it, where you see UK gilt yields at their highest level since 1998 and then some. And the British pound feels like it's staring stagflation right down the pipe. They're going to have sticky inflation. Their currency's falling. They don't get the insulation of a stronger currency like we do, even on a relative basis versus some others. The economy's been in such a difficult position post-Brexit, and that continues to get worse. I see literally no good reason why I would want to be long the pound here. And I get the volatility environment that a lot of people are looking at. The currency options, they are going to be trading tomorrow. Currency futures are trading all day tomorrow, by the way. And those European markets are open full day, so they're not exactly observing the death of a former U.S. president. So these should be moving still. Not a lot of UK data tomorrow morning, though, worth noting. Nevertheless, though, I mean, this is not where we were in August, September 22, but we're still in a pretty uncomfortable position. The context there, of course, is right after the Ukraine war, European natural gas prices go through the roof, trading at levels that are equivalent to like $550 a barrel in oil terms, US dollar oil terms. At what point do we look to the bond market? I keep asking this question. I asked it on First Call with you on Sunday. At one point, do we see the bond yields get to a place where investors go, you know what, this is just gravity at this point. This is just math. We're not going to be able to outpace through corporate earnings growth, the increase in the cost of goods sold. We're not going to be able to. This is going to weigh on our ability to project the strength of cash flows into the future. At some point, you have to take earnings down a notch, your estimates.
Yeah.
When? If not now, when?
Well, I don't think that what the markets are telling us here is that they're not worried, but I also don't think that they're telling us that they know to be worried in full. So when you see the kind of response that you got to ISM yesterday, right? Nobody thought going into this week, and in fact going into December, because really the majority of the policy adjustment, the hawkish rethink in Fed policy expectations and thereby in rates and in borrowing costs, that happened between September and November. The yield curve, in particular the Fed funds futures curve, has barely moved since early November. What the Fed did in December was not earth-shaking in the slightest, because by then the market's already moved. By then, what the Fed was doing with its hawkish rethink was essentially endorsing where markets already went, marking up break-even rates, marking up the whole yield curve, 2s and 10s, marking up the dollar. So we haven't really had a situation where anybody would have been confused, like, oh, the U.S. economy is a little bit hotter, we need fewer rate cuts. But then you get the ISM number, and the markets go, wait, like this is more. This is news. And equities very pointedly sell off. So it's not as if the markets aren't sensitive to the idea that we're getting to a place where something has to give, where it's going to be very difficult to maintain earnings expectations as they stand if rates keep going higher, that we're at some kind of an inflection here. And I think what the markets really are waiting for is to see whether they should be concerned or whether that ISM number is a one-off. And to see, like, where is the economy actually? Is it still heating up? Now, the Citigroup data that I like looking at that measures the performance of U.S. economic data relative to forecasts, that has been a very good filter for looking at what the markets think about the business cycle as relative to Fed policy and the sequencing there. That's been cooling since mid-November. And that's where we sort of got the idea. I certainly got the idea that just like in September, the Fed looked like it was more dovish than reasonable, because by then the flow of data was already going the other way. It was already improving. So the markets readjusted to something more hawkish. When the Fed followed them in December, data was already cooling, so it looked like maybe things were ready to go the other way. But they haven't, and the ISM number only complicates that. Now, at this point, if you look at that Citigroup index, it's basically at zero. So expectations and reality are aligned. We're really standing at a knife's edge. This thing is going to go one way or another. But we need some sort of tangible data, and NFP is probably the next opportunity. We need a tangible piece of data or a tangible catalyst of some kind to tip the scales. We are literally dead even here.
How much will the non-farm payrolls report on Friday weigh in on all this? If we get a hot number, our Treasury yield's about to take the next leg up. Are we gonna? We've already pushed rate cut odds back. We have one price for the first half of this year.
Yeah.
Two for the year total, right? It's like
Barely
June and November of the pricing. You're on the precipice of basically kicking this down to one.
Yeah. I mean, you're at about 40 basis points, 39 basis points for the year. So, yeah, you're narrowly expecting 2, but it's close.
Isn't that going to be the bottom in treasuries, right? We saw this last May. May 1st, you get a 0.3% chance that the Fed hikes rates by 25 basis points at some point in 2024.
Yeah.
And when the Fed comes out and says, no, we're not at the FOMC meeting that day, then bonds take off for the next few months. They rally up until basically through September, early October, right?
Yeah.
So
well, yeah, because exactly, because by then the data's cooling and the Fed goes, we're reluctant to cut, and there's no progress on inflation, blah, 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 blah. And the market goes, what are you kidding? Data has been cooling for a month and a half now. Stop it.
So if the juice has been squeezed out of Treasury cut odds,
yeah,
then as we decompose what's driving the long end of the curve, then the only thing that could be standing in the way here is it the uncertainty over inflation moving forward?
Yeah.
I mean, the FOMC minutes were pretty clear today. They told us on December 18th, we're not thinking about Trump's policies. And then we get the minutes today, and it's like, yeah, we're very clearly worried about what Trump's going to do for inflation.
Yeah, we're concerned. Yeah.
Right. So like the
uncertainty is high.
Right. And they if you read through them line by line, it's pretty clear that like we don't know. Not the policies in the first term, not all of them were inflationary.
Mm-hmm.
We don't know what's going to happen, but like the paths are now wide open, so to speak. And so is this the uncertainty over how tariffs can actually impact the economy? Is this why treasuries are trading the way they are? Is this the uncertainty that term premia expansion, you need to be compensated if you're going to hold fixed income during a time when trade wars may start up again?
It could be. That is certainly a possibility. That essentially you're just saying, you know what, who knows what inflation is going to do? But the Fed is telling us the data is volatile. The fiscal side looks like it'll be volatile one way or another. And so if I'm going to be lending money, sort of in simple terms, at a longer tenor, then I'm going to want more compensation for who knows what risk. Now, IV rank here is not the highest, but it's also not negligible. If you look at where the move index is, which is sort of overall view of volatility in the fixed income space, it's not sort of screaming, but it's not nothing. We've seen that sort of narrowly over the past, let's call it almost a month. The low was about December 12th. We've clawed our way now to the highest reading on this move index since late November. We've been drifting higher. Now, it's not a whole lot higher. We were a lot higher on this in early November. We haven't even retraced 50% yet of the decline from the beginning of November to about the middle of December. So, yeah, there's a slight pickup in Treasuries vol, but it's not anything scary or anything that's out of sorts. In fact, we're probably slightly on the lower end of average here for the past several years. So it's possible that that's what's going on. I think at this point, the market is just struggling to really make heads or tails of anything. And so the last piece of headline news that appears is the last thing that happens. We basically did absolutely nothing in December for the most part on rates. We get one ISM number, and there's a move. I think that's what's going on. What's going on now? We're just taking it headline by headline, number by number. The FOMC minutes didn't say anything scary. Okay, next. Of course, then NFP is the next thing. And the question will be, well, if data now is tending to meet expectations, looking at what Citi is telling us, those analytics, then really the big head scratcher is what happens if the numbers are about in line. Because then the market gets a chance to say, yes, I care about fiscal policy risk, or no, it's still all about the Fed. Who knows anything about fiscal policy here? If I don't get a Fed lead, I'm not doing anything. And that'll be an interesting thing to surmise.
Yeah, let's turn our attention to metals for a little bit. It was a good day for metals, despite the back and forth that you see in equity markets and the back and forth you see in bonds, particularly at the long end of the curve. Gold continues to inch up. It hits a new year-to-date high, which I don't know if that says anything. The year's less than a week old, or just a week old now in trading terms. I digress. Silver is trying to poke its way back through about $31 an ounce right now. This area where the market's toyed with as resistance and support going back to July, the uptrend off of the August and November swing lows here. We can't quite get through. On the other hand, copper is up 1.74%, a really nice move here as it seems like we're working our way off of a bottom right now. Are metals the canary in the coal mine throughout all this? You know, you would think that the 20-year yield up at 5%, the 10-year at 4, encroaching 4.7%, 2 years holding up above 4.5%. You see all these things, the strength in the U.S. dollar, gold, silver, these dollar-denominated metals should be taking on the chin. Is this a precursor of something to come?
I mean, if you look at copper in particular, and then you look at gold, what this is a precursor to is kind of muddled, because copper going higher is a straightforward growth indicator. This would tell you that there is optimism about demand at the industrial level. And very clearly, as you see a wiggle up in gold, it is not a story about that, because gold is not an industrial metal, and you don't really have a strong lead for the dollar or for yield in what you saw today. So as you look at all this, you go, okay, well, if the metals are a lead, where is it leading then? Do I believe gold, which attempted to claw its way higher? Do I believe copper, which had a much more convincing rally? That convincing rally maybe is an indication of something positive growth-wise, but what that is today is unclear. The situation in China, the largest buyer of copper, certainly has not seen any notable positive development over the past, let's call it 24, 48 hours. Nothing has really changed. So it's unclear exactly what to read from the metals here. Copper would tell you that there is a risk on flavor, but equities, gold, the dollar, all of them would contest that idea. So maybe copper is just doing its own thing.
Maybe it's China. Who knows? Australian dollar likewise down today, although off the lows. Chinese shares, FXI down by 0.42%. It wasn't really a strong day. We're too exaggerative a session either anywhere. One thing that disappoints me today, though, is what's happening with the semiconductor stocks. Yesterday, we were looking at SMH because we did have the breakout at the start of the week. We then had the pullback. Today, we are just not really ready to give it up. Listen, if you're a bear, you look at this and go, hey, we're closing lower today than we did yesterday. And if you're a bull, you're going to say, you know what, we got that nice wick that's more than half the candle, right at that 1 week moving average, right up where we should be finding support. Sucks that this is closed tomorrow. I'd like to get a little bit more resolution here. But it's not so much that NVIDIA pulls back in today. I don't think the NVIDIA price action itself is really the story of today's market. It's down by 0.02%. I think it's what Jensen Huang says about the variety of different quantum computing companies. He says that quantum computing, those that are going to make a real difference, are probably 15 to 30 years away. QUBT Quantum Computing Inc., which saw a huge explosion in share prices from near $1.50 a share back in November, trading as high as $27.15 a share after Google's Willow project announced that it had achieved, a computation that if it was done in traditional computing, there's not enough time left before the heat death of the universe to figure out, which of course people like Mark Andreessen came out and said this is clearly evidence of parallel universes existing. You see, Google's quantum computer, of course, is tapping into the multiverse and borrowing time from across the multiverse to complete this computation here in our little Earth 616 sliver. Obviously, Jensen Huang probably knows a little bit more about GPUs and computing than Mark Andreessen does. And sure enough, his comments sink these quantum computing stocks across the board here today, Ilya. Sure. So much for that, right? We had semiconductors last year, the year before. We had a little bit of quantum computing in 2024. It's getting hit on the chin here today. Are you surprised that we're seeing Ion Q? Are you surprised that this bubble is being deflated so quickly? And ultimately, is that a good thing for the market that we're relieving ourselves of some of these speculative excesses on the technological frontier early on before we put billions and trillions of dollars of capital behind them?
It seems like what this says is the market is not prepared to jump from the AI hype to a new hype without first kind of digesting the preceding one. That the idea that we've talked about here with Dylan at length, the sort of super glide idea that we are in the next great technological age and that we're going to go from thing to thing. And first we have AI and then quantum computing and then teleportation and then Skynet takes us all. We clearly, I think, are getting less enthusiasm here, at least for what would be the next kind of big, this is the next whatever it is phase. Quantum computing was obviously the next kind of natural candidate for saying, well, if you're building out for AI, we'll build out for this next. Yeah, not really. Not so much, at least not yet. For me to think that anything like a return to less effervescent valuations is afoot, I would need the AI hype to start to really fade. And I think to really see that, you don't just see NVIDIA stall. You got to see some failures. You got to see some players in the space take it in the teeth. And that may be coming. The thing that I always revert to talking about when I think about AI and that I always revert to thinking about is every other time something like this has happened, it's come in broadly 2 acts. The first act is always short, but very exciting. Lots and lots and lots of hype, lots of hope. Everybody suddenly has the same idea and goes, oh my God, this is a transformational sort of change, jumps on it, extrapolates wantonly about what it'll mean. There's massive overbuild, but then there is the sobriety phase where where all of the weak hands, all of the hopium is washed away, and whatever thing then builds out to its longer term positive narrative, be it railroads, be it the United States itself, frankly. I mean, the colonies and their debt were very much a speculative bubble at one point, be it telecoms and the dawn of the internet. So there's all kinds of reasons, I think, to think that AI is indeed the future and that the broad strokes of the conversation make sense on the positive side, but also that we haven't seen the intermission, as it were, between Act 1 and Act 2. And for me to be a believer in the long-term narrative, I want that intermission clear as day.
Quantum computing ETF, which doesn't even have Google in it last time I checked. That's down 4.61% today. The four big names in the space, Ion, quantum computing, qubits, Rigetti, those are all just in D-Wave, taking it on the chin right now. We'll see whether or not this materializes to anything in the future, but it's funny, some of these companies just don't even make quantum computers. They make some things that are related to quantum computing themselves. If we're 15 to 30 years away from a commercial application, Ilya, there's part of me that says, well, some of these companies probably should be trading back to where they were in November before junk took over the market. I digress, though. I think it's a good thing, quite frankly, right? We talk about, and I said a few weeks ago when this first came out, you know, you're looking for the next thing to inflate the bubble. Part of the reflexivity of bubbles is that you find a piece of evidence that allows you to keep believing more or less, right? And quantum computing could have been that next leg forward, and perhaps it's not. And if it's not, then that poses a narrative challenge where in the short term speculative, you have one less thing to hang your hat on, one less item of interest for trade